the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point.
They still believe that they were restrictive and that even with a 25 basis point cut, they maintained that level of restriction.
I actually think they did the right thing. I'm pleasantly surprised they went to 2 cuts next year.
We're not seeing a meaningful dialing back of policy in the months ahead.
They're signaling a pause, but it's also important to remember that by March, the forecast might look a little bit different.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Have you recovered from yesterday yet? Live from New York City this morning. For our audience worldwide, good morning, good morning. Bloomberg Surveillance starts right now. Coming into Thursday, looking to try and forget Wednesday. On the S&P 500, the biggest one-day loss since August, the worst Fed day for equities going back 20-plus years. And Lisa, I believe that's 13 straight days of negative breath.
And it's negative breath for all the wrong reasons, with some of the high flyers catching down to the rest of some of the underperformers. There is a larger question here. Why such a huge reaction to a press conference that on the margins was largely in line with people's expectations? Yes, it was a bit more hawkish than people previously thought, but this was a seismic shift. The Fed put is not there anymore. This is a flipping and flopping Fed. And frankly, the degree of uncertainty about how this Fed is going to respond to fiscal policy really just took the uncertainty and the lack of risk-taking to a new level.
I'm not sure who was more confused, Chairman Powell or the people listening to him. This was the feedback we got. Capital Economics, hawkish cut. Citi, unexpectedly hawkish. Bank of America, unabashedly hawkish. Standard Chartered Steve Englander with a question, an important question. The real question is, if you are going to be so hawkish, why bother cutting?
This, to me, actually was the thing at the top of my notes this morning, because ultimately he was asked that question and the answer was unsatisfying to markets. People didn't get a real sense of what the barometer was and how much this really did hinge on the expectations for what happens next year. When he said that some members just casually or generally, theoretically penciled in some assumptions based on what the Trump administration would do, indicated to some people that this was going to be a Fed that assumed an inflationary impulse, responded according to that assumption, and could even get behind the curve when it comes to weakness that is incoming. RBC Capital talking about that this morning.
So typically we'd be frustrated by a full slate of Fed speak. I think the Fed speak this time around going into year end could be absolutely fascinating. We all had the same question going into the news conference. We looked at a forecast. Take CPI. They had to push that higher into next year. Take the median dot. That drops lower from 4 cuts implied down to 2. Why? Is it the data or Trump? Then we started to reflect on November's meeting of the news conference. We don't assume, we don't guess, we don't speculate. And then in the news conference this time around, some people assume, some people speculate, and some people guess. And the question that I'd have going into the Fed speak over the next few days is, which policymakers did that? Which ones didn't?
And just how splintered is this FOMC? Chair Powell has done a good job of trying to keep the sense of unity over the Federal Reserve for the better part of his tenure. That broke down this time. That broke down in a big way. Not only did we get 4 dissents, including 3 from non-voting members, but there was a sense that he was struggling to make sense of a very non-consensus on the board committee. And so to me, I want to understand who holds the keys to what happens next, who has a model, who has some sort of scenario analysis that the market can hook their teeth into.
Where do you think they are now? Q1 of this year, worried about inflation, turns out to be a head fake. Q3 of this year, through the summer, worried about unemployment. We all remember the Jackson Hole speech in August in Wyoming. Worried about the labor market. All of a sudden, feels like they've shifted back to inflation again, going into the new year.
I don't think there's a consensus right now. That's the issue. And that's why I think that Fed Chair Jay Powell gave a very confusing speech that really didn't answer the ultimate question of why would you be ratcheting up your expectations of inflation, saying inflation, bringing it down to target is still really important to you, and then cutting rates. All of this didn't make sense, but he was contending with the fact that everybody was using a different model. People were questioning the data. And ultimately, there is this real concern on the FOMC. Why has inflation continued to surprise to the upside despite rates as high as they've been?
3 meetings, 100 basis points of cuts across those 3 meetings. The recalibration phase is over. Equities right now on the S&P attempting to bounce. We're up by 0.4% on the S&P 500. Yesterday on the 2-year and the 10-year, a double-digit move higher. Yields up again this morning by a single basis point. These are levels we haven't seen since May. On a 10-year, 452.41. Coming up this hour, we'll catch up with Jim Bianco of Bianco Research following the worst Fed day for stocks since 2001. Bloomberg's Tyler Kendall as the stopgap funding bill collapses in Washington. And we'll catch up with Matus of MetLife on whether the Fed can cut at all next year. We begin this hour with the S&P 500 coming off its biggest one-day loss since August. The Fed delivering a 25 basis point rate cut, but dialing back expectations for cuts next year. Jim Bianco of Bianco Research writing, cutting rates and leaving the door open to more is inviting higher inflation expectations, and that is what the market is reacting to. Jim joins us now for more. Jim, we've got a lot to get through. Your early reaction to yesterday's news conference?
You know, you have to see it as a continuation of what we've seen since September. When the Fed cut in September, we were at 360 on the 10-year note, and yields have been going higher and higher and higher. Chairman Powell's been asked about this, and he's not answered the question. He said they go up, they go down. And then he come to yesterday's meeting, which we're referring to as a hawkish cut. Let's call it what it is. He made a very good case to raise rates yesterday, but instead they cut rates. And I think the market at every step has been worried about inflation and has been rejecting these moves by having yields go up and up on the long end of the curve. Why? Because the economy is growing at its potential. We've got massive stimulus coming with the Trump administration. Monetary ease is unnecessary. All it's going to do is raise inflation expectations. So every time they cut or talk about cutting, you see higher long-term yields.
Jim, what do you think the next move is? Beyond no move. Is it a cut or a hike?
I think the next move, you're right, is first of all, it should be no move, even though Chairman Powell talked about a pause, meaning that there's going to be moves in the future. It probably should be a hike, because if we're talking about where neutral is, where is the rate that does not, restrain or stimulate the economy, you can make the case we arrived at it yesterday, and that the amount of restraint, as Chairman Powell calls it, doesn't really exist. So therefore, the next move should probably be a hike, but that's going to be intensely political. President Trump wants to fire Powell. President Trump would go crazy if he saw the Fed raise rates. So they're trying to thread this needle from a political standpoint, in my opinion, and they're coming up with an answer that is satisfying nobody.
Jim, do you have a really clear sense, and I know that you just gave a reason for why the market responded the way that it did, but how much do you think it had to do with the idea that there is this concern about stickiness of inflation, and how much is it the flipping and the flopping and the lack of direction, the lack of understanding? What models are driving any further Fed decisions?
Oh, I think that you're right, that it is a flipping and a flopping. We're not exactly sure where they are going. You remember in the summer, we got all worried about the unemployment rate, as you pointed out. That was the basis of the Jackson Hole speech. I happen to think that that was all driven by the Somme rule getting triggered, and that scared the Fed, and that's what got us to 50 basis points. And right after that, the labor market rebounded, and now we're back to inflation. So there is no real consensus. Add to that, as you pointed out, there were potentially 4 dissenters at this meeting, although officially there's only been one because 4 of them not listed their 2024 dots as being unchanged. And this is a Fed that is probably deeply divided. They don't have a clear idea among themselves what they should be doing next. And when Chairman Powell goes out there and tries to tell us that here's the policy, there is no policy. There is just, kind of questions, and there's dissent all over the place, and that is showing up in the market.
Jim, in some ways, the Fed put has been taken away. The comfort that at some point, the default for this Fed will be the recalibration to lower rates, because it seems like they're very close to that neutral rate. I just wonder, going forward, how much this is a Fed that welcomes the weakness that we saw yesterday in the markets, that actually welcomes some of the sell-off, that takes a bit of the pockets of froth down a notch.
Oh, I think that they probably do welcome the idea that these frothy markets, especially in post-election, especially in the more speculative markets like crypto, have been worrisome for them, and they would like to see them pull down. But I don't think they like the idea that these frothiness is coming away because everybody's screaming they just made a policy error, and that's why the frothiness is coming away. But yes, I think that in the long run, they would probably like that. But again, that puts them at odds with incoming President Trump, because he values, or he views, his success of his administration by rising stock prices. And the Fed is now probably saying, well, at least we got stock prices down and got some of the froth out of the market. So it's going to be a very tumultuous 2025 if we continue down this path.
Neil Dutta of Renmark said it immediately after the news conference yesterday, Jim. Neil came on the program and said this Fed is on a collision course with the incoming administration. Jim, how do you think that plays out through the next 12 months?
Oh, I think it's going to play out, not well at all, because I'm going to take Scott Bessent, the incoming Treasury Secretary, as his word that there's probably going to be a shadow Fed. That is the idea that they're probably going to nominate Kevin Warsh early, like this summer. So we're going to have a Fed chairman. We're going to have a future Fed chairman, and we're going to have two people to kind of listen to, and that will add to the confusion as well. So this is not going to be something where they're just going to clash with the administration. It's going to be open warfare. And we're going to have probably potentially a future Fed chairman to sit there and question what the current Fed chairman is doing.
Jim, that will not be music to the ears of people in Brazil, to people in Japan. And by people, I mean policymakers. Dollar yen right now, briefly through 157. In Brazil, they've got fiscal issues. These issues don't help them. In fact, higher yields beget higher yields. Jim, there are certain places in financial markets around the world where they feel really stretched. We had someone come on the program yesterday, Julian Emanuel of Evercore, a man you know well, and he talked about the peak in the US dollar being really important to financial markets. We've been asking the question, how much oxygen is left up here for the US dollar? Jim, how much more stretch can this get?
Oh, the one thing I've learned about currencies is they can go a lot further than people think. And as long as U.S. rates continue higher on this back of that the Fed is not dealing with an inflation problem, or worse, fostering it by continuing to talk about cutting rates when it's not necessary, higher interest rates in the U.S. will just continue to foster a higher dollar. Now, a higher dollar, you're right, means lower emerging market currencies, which means lower developed currencies like the yen, and puts more and more pressure on them. And look at what's happening in the global economy ex the U.S. You've got countries like Germany, you've got countries like China, you've got countries like Japan that are already struggling right now. Germany might be in recession right now. Japan might be in recession right now. China might have some of the lowest growth that we've seen in 40 years. The U.S. is humming along great, but the problem is that as the U.S. hums along and gets higher rates and sucks the dollar in higher, it puts the rest of the world under further pressure.
Jim, putting this all together, the rest of the world on further pressure, the idea that a stronger dollar is probably going to inhibit exports from the U.S., potentially the growth in certain areas. Did this meeting and the reaction to it by the Federal Reserve and by the markets increase the chance of some sort of negative growth shock next year, despite some of the incoming policies?
It can. I mean, if you go back and you look at recent history, 6 years ago today was the day that Powell had another press conference where there was a very bad reaction in the market. That was when he announced QT, and it was going to be like watching paint dry, and the market thought it wasn't going to be like watching paint dry, and it had a very toxic reaction to it. 2 weeks later, we got the Powell pivot when he went to Atlanta at the NABE conference and basically pulled a piece of paper out of his pocket and said, okay, those policies announced 2 weeks ago, we're going to completely reverse them. So maybe we see something like that in the next couple of weeks out of him. It would be, there's a precedent for it, that he changes the policy. But if he doesn't change the policy and they continue to talk about weakness, worry about the labor market, that they might have to cut rates even more next year in the face of just raising their inflation expectations, I think we're going to see a rocky ride in the markets.
Jim, enjoyed it. Looking forward to covering this with you. Jim Bianco of Bianco Research. And Jim, thanks for everything in 2024. We'll see you no doubt in early 2025. We went through this yesterday, the year-to-date moves in foreign exchange, and pinpointed what's been developing in emerging markets, not just over the past week, but through much of this year. Moves of more than 20% against the Brazilian currency. Moves of 21% against the Argentinian currency. Moves of close to 17% against the Mexican peso. That's painful for a lot of those countries.
It's painful, and it potentially could even alter and inhibit how much they can drop rates to stimulate their economies economically. Because if they do see further depreciation of their currencies, then when they import in any kind of dollar-based or dollar-priced asset, that is going to be an inherent inflationary force. It kind of creates a real spiral for a lot of these economies.
DXY just a little bit softer on the session at the moment, pulling back from 108 at 107.90. Just amazing. We're negative by about 0.1%. With an update on stories out elsewhere this morning. Let's get to your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Good morning, John. House Majority Leader Steve Scalise says the stopgap funding measure released Tuesday is dead. Scalise's announcement comes after President-elect Donald Trump came out against it and threatened to oust fellow Republicans who don't meet his demands. That includes raising the debt limit along with the legislation. If lawmakers can't reach a new agreement, the government could shut down Friday night at midnight. Meanwhile, Micron shares are plunging down 15% in the pre-market. The largest U.S. maker of computer memory chips announced earnings and revenue guidance that missed analyst estimates. While orders remain strong for components used for artificial intelligence, it still hasn't seen a pickup in demand from makers of phones and PCs, two markets that make up the majority of its chip volume. Still, Micron CEO said he expects a return to growth in the second half of the fiscal year. And AT&T and Sweetgreen are the latest companies telling employees to come into the office more often starting next year. The telecom giant will require U.S. corporate employees to be in the office 5 days a week, while the salad chain is moving to 4 days a week for the few hundred support staff who don't work at the restaurants. Employees at both companies currently go into the office about 3 days a week. Must be nice. That's your Bloomberg Brief. John?
I feel the same way. And every time I hear these stories, and thank you, Yahira, I think the same thing. Where have they been for the last 12 months?
I understand. At the same time, have you seen these studies showing that people who actually offer hybrid work get a lot more applicants to work at their companies? So I just wonder, at what point do you actually just say, look, the norm is now going into the office?
Okay.
I'm trying to be generous.
I
because
hear
it's like, at a certain point, it's just sour grapes on my part, having to,
sour grapes on my part, too.
100%. This is just personal, and I want to be a bigger person.
I'd like to still be in bed, TV screen behind me as a headboard,
my
sort
goal
of sit up.
For 2025 is to be a bigger person.
Good for you, Bramo. Let's see how that works out. Up next on the program, Trump pushes back on the budget.
We got to get this done because here's the key. By doing this, we are clearing the decks and we are setting up for Trump to come in roaring back with the America First agenda.
That conversation up next. Live from New York City this morning. Good morning. Francis Donald from RBC joining us on the program a little bit later, echoing what Lisa was talking about earlier on this hour. There is no consensus at the Federal Reserve. There is no conviction in this FOMC. So trying to decipher their perspective/bias as a whole is probably a fool's errand. Something you were making a point of about 19 minutes ago.
Essentially, a couple months ago, everyone was talking about the Fed put being back, and that essentially put a floor under valuations going forward was a tailwind at a time where downside growth shocks would be met with potentially a Fed rate cuts. If you have FOMC members that are concerned about the potential for inflation from future policies that have not been put out there yet, that might not be the bias anymore, and that Fed put is gone.
Certainly questioning the easing bias in the last 24 hours, attempting to bounce back from the biggest one-day loss on the S&P since August. We're up by 0.4% on S&P 500 futures this morning. Under surveillance this morning, Trump pushing back on the budget.
Vivek and I talked last night about almost midnight, and he said, look, I get it. He said, we understand you're in an impossible position. Everybody knows that. Remember, guys, we still have just a razor-thin margin of Republicans, so any bill has to have Democrat votes. They understand the situation. They said, it's not directed to you, Mr. Speaker, but we don't like the spending. I said, guess what, fellas? I don't either. We got to get this done because here's the key. By doing this, we are clearing the decks and we are setting up for Trump to come in roaring back with the America First agenda.
So here's the latest this morning. President-elect Donald Trump opposing the stopgap funding bill Speaker Mike Johnson and Democrats presented on Tuesday to avoid a government shutdown. Trump pushing for lawmakers to increase the debt ceiling, writing on Truth Social, the most foolish and inept thing ever done by congressional Republicans was allowing our country to hit the debt ceiling in 2025. It was a mistake and is now something that must be addressed. Joining us from the nation's capital, Bloomberg's Tyler Kendall. Tyler, what's the latest this morning?
Yeah, good morning, John. Bloomberg News reporting that Vice President-elect J.D. Vance spent last night on Capitol Hill negotiating with House Speaker Mike Johnson. Now, of course, this all started to unravel yesterday with the initial criticism by Elon Musk and Vivek Ramaswamy, and then was cemented when President-elect Donald Trump voiced his opposition. So the original bill would have funded the government through mid-March. Interestingly enough, Trump says that he does support some supplemental funding in a new deal, notably disaster assistance and economic assistance for farmers. But he ultimately said that the current bill had way too many provisions in it that he thought would help Democrats politically. But as you alluded to there, he didn't just oppose this bill. He went 2 steps further. One, he told Republicans that they need to raise the debt ceiling, of course, a politically fraught issue that he admits he doesn't want to have to deal with during his term. So he'd like to see that addressed now. And second, he threatened any Republican who came out against that idea that he would support a primary challenge against them. It actually echoes a similar threat that we heard earlier this week that he made against Senate Republicans who might be thinking of voting against his nominations. He says for political reasons. But John, if I've learned anything from living here in Washington, it's that when one election ends, another election truly does start. And Republicans are paying close attention to this because in 2026, the next midterm elections, Republicans are going to be defending 20 Senate seats. That is about double the amount that they just had to defend in the 2024 elections that ultimately helped them flip that chamber. So that all just goes to say that there are going to be many more vulnerable Republicans, kind of a captive audience, if you will, who will be listening to these threats from the president-elect over the next 2 years.
I had to be thinking about this children's book, If You Give a Mouse a Cookie, when I was reading some of the negotiations, because essentially Mike Johnson proposed and added an additional $10 billion for farmers, and then all bets were off. It was to the races, and the Democrats added in a pay increase for members of Congress, new regulations for health plan administrators, the RFK Stadium, moving it to Washington, D.C., and then the gates were open. I just wonder how much this highlights how splintered the Republicans are and how difficult it's going to be to get through some of the proposals that the Trump administration has put forward.
Exactly. This is actually setting up a conversation that's going to show that it's going to be difficult in the next Congress. We know that Trump is asking Congress to prioritize 3 things that he wants to see them work on right off the bat come 2025. That's immigration, energy, and tax cuts. And it's opening this conversation, particularly from more conservative members of the House Freedom Caucus, and they're saying that if there's going to be tax cuts, there also needs to be spending cuts. Because at the end of the day, while we are talking about too many provisions in this bill that originally came out, and President-elect Trump taking issue with some of them, notably that members of Congress would have gotten a pay raise. The initial frustration with this bill from many Republicans was that there wasn't enough pay-fors to offset all of this spending. And that's already starting to bubble up when we talk about these conversations for next year, particularly that Trump has proposed a litany of tax cuts that one Bloomberg analysis shows that if they were all implemented, including making permanent some of the 2017 tax cuts, but also some new proposals like eliminating tax on tips, overtime, Social Security, that would amount to $10.5 trillion being added to the deficit over 10 years. That's something that Republicans are going to have to grapple with in the next Congress.
Tyler, just quickly here, do we have a sense of whether Donald Trump would have torpedoed this without Elon Musk coming out first and really being angry about it?
Right. So I actually was talking to one Republican strategist about this who said that he doesn't necessarily blame Elon Musk here, since he's the one that's tasked with cutting government spending. And perhaps the easiest way to do that is to cut the spending that hasn't happened yet. Now, Republican Congressman Andy Barr, a Republican from Kentucky, came out yesterday and told reporters that his office was flooded with calls from constituents saying that they had seen Elon Musk's posts. And that is what ultimately propelled them to call his office and say that he needed to vote no on the original bill. So it's clear that Musk's reach, his constant posting on X yesterday, ultimately helped kind of stoke this fire that ultimately led to Trump having to put out this statement saying that he unequivocally opposed it, citing many of the claims that Musk had originally put forward, saying why he didn't like the bill in the first place.
Tyler, great reporting. As always, Tyler Kendall there down in Washington, D.C. The incoming president has got a tough job. You need a big psychological shift down in Washington, D.C. There is an addiction to spending that grips both parties. And we've seen that. You described it, the process of the last week or so. You've seen that play out.
The problem is there is some spending that can be productive, but there is no overarching mechanism to look at what's productive and what's wasteful. And that's what people are hoping for. Whether that can be put in place is another story.
More on that story a little bit later. Coming up this hour, Iain Stealey of JP Morgan on a Fed chair. JPEL. The picture this morning, very different to the picture yesterday afternoon, bouncing back from some big losses across the board. Equity futures look like this. On the S&P 500, up by 0.4. On the Russell, the small caps, up by 0.4%. You saw the moves yesterday afternoon at the close, the biggest one-day drop since August on the S&P 500, since July on the Nasdaq, since June 2022. On the small caps, the Russell got hammered.
And what was the surprise? I keep going back to this. Why the big reaction? Was it simply because they took one rate cut off the table than the market was expecting for next year, now only 50 basis points of rate cuts? Was it the fact that there was clear confusion on the FOMC and dissent? Or was it the idea that this can no longer be considered the tailwind that everyone was hoping with the soft landing nirvana also of tax cuts and deregulation?
Coconuts don't just fall from the tree. Do you remember that?
Yeah.
Kamala Harris would talk about the context. Got to talk about the context. Let's talk about the context. Don't know why I felt the need to throw that in.
No idea either.
But let's talk about the context.
Let's go with it.
It's important.
Yes.
This meeting failed because of what happened at the November news conference. My take is that his approach to the November news conference set them up to fail at this one when they had to produce forecasts this time around. And this is why. In the news conference, he comes out in November and says, we don't assume, speculate, we don't guess. Easy to say on November 7th, shortly after the election, when you don't have to produce a forecast. In December, you have to produce a forecast. And it's obvious. So you ask the question, did you assume, speculate, did you guess? And he had to come out and say that some people did yes. How much of the change in the forecast was about Trump? How much of the change in the forecast was about the data? And the lack of conviction explaining as to what was what, I think underpinned the confusion for much of that press conference yesterday.
Especially because it was not clear that he understood that either. At a certain point, this is a confusing moment, and I think that you're right. If in November he had come out and said, look, we honestly are in a black box right now. We need a month or two to really settle out and to understand what the implications are. And right now, each member is dealing with it the way that they can, and I'll get back to you. That might have been a more honest answer. The difficulty is, this is not going to be a market that he can please because it is a market that is splintered also, and he, trying to give clarity, actually muddied the waters at a time where it's clear they don't have an upper hand.
He was burdened by what has been in the bond market. 2-year yields lower by 3 basis points. Nice. 432.28 on a 10-year. Yields up again by 2 basis points. The 10-year 453.41. That move on 10-year yields continues. That move on 30s continuously. So yields are up.
At a certain time that people are talking about, if you are concerned and revising up inflation expectations, then why cut it all? And that was the ultimate question that was not answered in a way that gave this market satisfaction that they were actually committed to tamping down inflation going forward.
With those high yields, Bramo, you know what happened in foreign exchange. Yields up, dollar stronger, the best performance for DXY since the post-election rally in the immediate aftermath of the Donald Trump win, closing at its highest level, I think, so far this year for DXY. Dollar yen, the move extends. We're up another 1.4% on dollar yen, 157, because the Japanese aren't ready to hike interest rates again over at the BOJ. So that stretch, that rubber band, just stretches even more.
Yeah, and there was one dissent among the 9 members on the Bank of Japan with saying maybe we should raise by 25 basis points. But again, this raises a question of how much some of these other central banks are going to have to respond to the strong dollar, more than maybe concern about weakness or not enough inflation if you're the likes of Japan.
Dollar yen, 156.95. Under surveillance this morning, President-elect Donald Trump opposing the proposed funding bill on Capitol Hill, threatening to oust fellow Republicans if they accept legislation that doesn't include his demands. This coming just days before funding is set to expire. The fun and games begin in Washington, D.C.
Is this fun?
It is not fun.
It is games.
It is certainly a game.
Well, this to me is a real question of just functionality and what can actually get done. And it highlights what Anne-Marie's been talking about all year, which is the narrow majority in Congress, despite the fact that the Republicans do have a majority. A real question of how much consensus you can get and what role Elon Musk plays. I keep going back to this. Elon Musk, the Doge taskmaster, came out and basically said, no way, no more spending, stop it with the raises. And then Donald Trump came out and said it too. How much is he going to be setting the tone for what gets passed and what doesn't?
Or maybe he's just part of the attack dog team. We've got to pick one here. Got to be consistent about this. A few weeks ago, you had Democrats coming out and saying he's got no power, Doge doesn't do anything. A few weeks later, he's got all the power, he's the sitting president. Which one is it? How much power does Elon Musk actually have?
Can't we have both?
I would say something in between. I think
honestly,
he has great influence, but but he has limited power.
Sure. And I think that that's the case probably for most people in Washington, D.C. Look, it is a stew. And I'm going to take a note from what I just criticized Jay Powell for saying, which is I'm not going to say with any certainty who has power and who doesn't, because ultimately, for as long as he's first buddy, he could have a lot of power in deciding what President Trump decides to say and how he decides to put his thumb on the scale with other Congress members.
Think about it like this. What's the president threatening to do? Primary people who don't come along with him. How do you primary people? You need some money. Where does the money come from? A lot of that money at the moment is coming from Elon Musk. So you kind of like put this picture together. That's how this is working.
So you're falling in the all the power camp?
No, I think power and influence is combined and money's behind that. That's what underpins it. And that's why Elon Musk has so much influence at the moment.
Bottle it. I think that we'll have to just keep going back to that.
I don't think that makes him the sitting president. I think that's very, very different.
I didn't say he was a sitting president. Let's move on.
OK. I can move on to the BOJ. The Bank of Japan holding interest rates steady. The yen weakening after Governor Ueda said the central bank needs more information on Japan's wages and Trump policies before making a rate hike decision. He's not the only one now waiting. We've got policymakers worldwide who are hesitant to make moves because they're waiting to see what happens with policy in Washington, D.C.
Yeah, but the market's moving anyway. And this is sort of the key question. And at 7 a.m., in about 25 minutes' time, we get a decision from the Bank of England. On to you, the ECB, later on when they meet next. How much does the currency depreciation in their regions affect how much they can cut rates, even if their economies might need it? And their economies are still existing, despite the uncertainty that we might see elsewhere.
More yen weakness off the back of that call earlier this morning. Elsewhere, Volkswagen and union leaders moving closer to a Labour deal that would keep German factories open. Sources telling Bloomberg management is willing to keep plants running and reinstate job security agreements until 2030 in return for workers foregoing bonuses. I'm not sure that's going to get it done with shareholders. This stock is down by more than 20%. This industry is structurally challenged. That company has 650,000 employees. And you've got to do something to restructure. And as we're seeing, it's going to be really difficult to do that over in Germany.
And if they don't, what does that mean in terms of job cuts? And when is the sort of relief lever coming from government? Oh, yeah, that's right. The government is in a complete disarray and isn't necessarily have any sort of cohesive center. So this is the issue. They need some sort of policy relief at the top and governmentally in order to stave off some of these closures. Otherwise, you have to imagine that those layoffs are going to continue.
Germany's an odd one. You've got all these countries around the world looking for fiscal space, and they can't because the market won't give it them. In Germany, they're looking for fiscal space, but they can't because it's self-imposed. It's kind of odd, isn't it?
Well, it's very emotional, and it goes to sort of this incredible sociological study, which is actually fascinating, and I plan to do it in my free time.
Let's get back to the Federal Reserve, and Lisa can continue doing that in her spare time and maybe in the next commercial break. The Fed making a predicted 25 basis point rate cut at their final policy meeting of the year. Iain Stealey of JP Morgan saying the Fed's decision to step to the side and slow the pace of rate cuts makes perfect sense. Having lowered their policy rate by a full percentage point from its peak, they can afford to be more cautious in considering further adjustments. Iain joins us now for more. Iain, welcome to New York and good morning.
Morning.
What changed yesterday afternoon for you?
I think you're in an environment where, and this is the problem that Powell had during the press conference, they just don't know. Like, I think Lisa said it, you've got dissenters, you've got some people putting an expectation of some form of tariffs into the forecast, you've got some not. There's just a lot of uncertainty. Everyone's got a lot of uncertainty at the moment. They're struggling with an environment where inflation has been a bit more sticky than they would have hoped for. They've had to raise all their forecasts. Growth's been a little bit stronger than they were expecting. They've raised all their forecasts. So it just makes sense to take a pause, take a break. They've done the 100 basis points they basically told us they were going to do in September. That's been forced through. It's happened. Now we're going to step back. Let's wait for the January meeting, go through that. We'll have more sense in March as to what the administration's going to put into play.
What is the price of that uncertainty? Of lower conviction at the Federal Reserve? Is it higher yields at the long end or lower yields at the long end? Which one is it right now for you?
I think the initial reaction is what we've seen. It's higher yields at the long end. Now, if we did just start to get to an environment where actually the data started to look a little bit more dubious and we were still uncertain that the Fed was going to react because they were possibly concerned about what the inflation expectations were in tariffs, then the long end is going to get a bit of a rally. But for the time being, I think we're looking at people who are just a bit concerned. We're not completely sure what's going on. And actually, the US economy is just doing better than had been thought.
I guess I'm confused why this isn't just making the long end a raging buy. I would actually think that this would actually make the bond market on longer duration more attractive if you have a Fed that seems to be suddenly no longer biased to cutting, is actually in the mood to fight inflation, considering the fact that this is a Jay Powell that really highlighted how surprised they've been from the stickiness of inflation.
I guess you got a couple of things. So it wasn't, what was interesting with the curve sort of moved up in parallel to some extent yesterday. So it wasn't as if people were focusing on one part. It was just a general move higher in yields. The Fed isn't going maybe as quickly as people had thought. We're still concerned about the fiscal side and what's happening on that. So it just means yields need to be a bit higher. I think the big question to me would be how high can these yields actually go? And I think that's to your point. It doesn't feel like we're in an environment where we were last September. The cash rate back in last September was 5.5. We were still expecting, or there's still a 50% probability of another hike. We're 100 basis points lower today. The Fed is still on an easing path, even if it's going to be slower. So although we are seeing a bit of a move higher in yields, it doesn't feel to me at least that we're going to go to the levels we saw last September, which means when things do settle down and when cool heads prevail, there probably will be a lot of people thinking, actually, at these levels, long-term strategic, the insurance you get from fixed income makes sense.
Going back to what John was asking, the risk premium and what you have to sort of bake in, that's sort of a new charge for the level of uncertainty that we see right now in the economy. I wonder if this makes credit less attractive on the margins, given the fact that companies are going to be evaluating the scene in the same level of uncertainty as the Federal Reserve and as economists and as traders.
I think from our standpoint, credit, the corporate fundamentals still look very strong. We're likely to get policy out of the administration that is credit and kind of corporation positive. We know that the administration is going to be looking at things like the stock market to decide whether they're doing a good job or not, and they sort of focus on things like that. To me, it's still a good environment from the credit side. Yes, credit spreads are tight, but the fundamentals are strong. I think the all-in yield's important.
But hold on a second. If maybe this is an administration that looks at the market and tries to make sure that the stock market is rising. And this is a Federal Reserve that watches the stock market rising and says that's froth, and actually is more inclined to keep rates higher, which sends the market lower. Who do you listen to more?
I'm not sure the Federal Reserve does look at the stock market, because the stock market's been going up, and they've continued to talk about tight financial conditions and things like the mortgage market. I think the administration does look at the stock market, so I think that's what we'll focus on.
January 10th, next payrolls report. Can this whole story just flip in the other direction again on one data point? Given the hypersensitivity of this FOMC to incoming information?
The market can definitely flip on that data point.
Can the Fed flip?
But I think you've got two things, because I think you do need to be jobs, but I think we've also heard that now inflation is back in the game. We had heard that inflation under control. We'd heard those comments during the summer that it was the labour market, the unwillingness to see the labour market deteriorate further. Now we've had that forecast from 2.1 to 2.5. Suddenly that's looking a little bit suspect. So I do think jobs is important, but I think we're going to be focusing on inflation as well.
Been whipsawed 3 times with seemingly no underlying assumptions about where this economy is heading. Is that unusual for a Federal Reserve chair?
I think it just shows the uncertainty we're in at the moment, and also it shows you how much the market can sort of drive the price action. Because actually, when you think about what did the Fed do this year, they had four cuts price, they went to 2, they went back to 4. It was the market that was at 7. It was the market that during April was saying, maybe we should be hiking again. And then it was the market that was back at 6. So the Fed's been a little bit more than the market. The market's the one that's been whipping around.
Iain Stealey at JP Morgan. Iain, appreciate your time. Thank you. Lisa, it's a point you made. The focus has shifted. The emphasis seems to be, relatively speaking, much more on inflation. And that's tempered the easing bias of the Federal Reserve, which has spooked this market a fair bit in the past 24 hours.
Yeah, to me, what stood out was his explanation of how concerned they were that inflation continued to surprise to the upside, and that was one of the reasons why they're rethinking just how quickly they are going to be cutting rates next year. A key question to me is, exactly to your point, John, what data points would it take for this FOMC to completely change its tone once again, for some of the FOMC members who might be in the minority this time to come into the majority?
Actually looking forward to the Fed speak going into the holidays.
Me too.
Looking forward to it over the next few days, that's for sure. If you are just joining us, welcome to the programme. Equities attempting to bounce back from yesterday's losses, the biggest one-day loss since the summer on the S&P and on the Nasdaq. We're higher by 0.4% on the S&P 500. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Supreme Court agreed to hear TikTok's challenge to a law that could ban the app in the U.S. if it's not sold by its Chinese parent company. Arguments will be heard by the High Court on January 10th, just 9 days before the ban is set to take effect. TikTok and its parent company ByteDance claim the law violates free speech protections. Meanwhile, Bloomberg has learned that Apple is scrapping plans to build an iPhone hardware subscription service. According to people familiar with the matter, the idea was to make owning an iPhone like subscribing to an app, with consumers paying monthly fees and getting new phones each year. But the project was scrapped due to a number of setbacks, including software bugs and regulatory concerns. And Barclays is set to increase its annual bonuses by as much as 20% after an improved year for traders and investment bankers. Trading unit staff are expected to see a 5 to 10% increase, while bankers in debt and equity capital markets could get 10 to 20% more. This is welcome news for employees after last year when dozens of bankers got no bonuses at all. That's your Bloomberg Brief. John?
20%. Yahara, thank you. Bob Michael, if you're listening, great job by Iain Stealey just moments ago.
Yeah, you need real analysis like that to
in
really
town
keep
for the
going.
annual eval.
Yeah, this is the great moment.
Find out the numbers in the next few months. Anyway, just throwing it out there, Bob. Up next on the programme, Chair Powell changing his tune.
In the near term, the election will have no effects on our policy decisions. Some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation.
That conversation up next. Live from New York, you're watching Bloomberg TV. So much to break down and digest following that news conference yesterday with Chairman Powell. They cut 25 basis points, called it a close call, then basically delivered a news conference which was pretty consistent with hiking interest rates over the next 45 minutes.
Yeah, and said that it was a closer call, and at the same time, really not necessarily giving clarity onto what would necessarily cause them to cut rates or even potentially hike rates in the future, even though that was not a likely possibility.
Welcome to the programme to all of you just waking up on the East Coast and to some of you waking up on the West Coast, which is incredibly early. Those of you over at PIMCO.
Go back to bed.
I don't think they can. Equity futures on the S&P right now bouncing back by 0.4%. In the bond market, yields higher by, let's call it 2 basis points. The 10-year, 453.41. Under surveillance this morning, Chairman Powell changing his tune.
In the near term, the election will have no effects on our policy decisions. We don't guess, we don't speculate, and we don't assume. Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting. Some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation.
So here's the latest, what a difference a month makes. Fed Chair Jay Powell admitting multiple FOMC members weighed policy uncertainty in their economic forecast. Drew Matus of MetLife focused on inflation, writing there remains a risk that inflation moves higher and, even if temporary, it may disrupt the Fed's path forward up to and including reversing course. Drew joins us now for more. Drew, welcome to the programme, sir. We all had the same question when we saw the updated forecast. How much of it was about the realised data? How much of it was Trump? Drew, which one was it?
Oh, I think to answer that, you have to look back to September. Why did they go 50 in September? And the answer is probably because they didn't want to have to go 50 right around the election. And then why did they go in November? Because they went 50 in September. And so now this is a little bit like, the woman who swallowed the fly, and they just keep trying to fix a situation and make it look like they're not political when in fact they actually seem to be becoming political. Put another way, they're like my teenager driving a stick shift car. It's like jerking forward and then backing, sputtering around, and the car just doesn't function well when that happens. And that's the market response you saw yesterday.
So, Drew, what do you think they need to fix when they convene again at the end of the first month of next year?
I think they need to work on consistency. You cannot be cutting rates and hiking your inflation expectations for the next 2 years. How that got through and someone didn't point it out. In fact, maybe the most market savvy person on the committee did figure it out. And President Hammack dissented because, it didn't make any sense what they were doing. And of course, she came out of, an investment bank and would probably have a sense that markets weren't going to respond well to this kind of messaging.
I love your comment. If an alien lands on the planet having studied monetary policy, would they think the Fed needs to be cutting here? I just love the idea of aliens studying monetary policy. Drew, I am curious going forward about really how this can be a Fed that is apolitical, right? I mean, essentially, all economists have some sort of political bias or see the world in a certain viewpoint. Is there a certain metric? Is there a certain scenario analysis test that would give markets confidence that this was a Federal Reserve trying to strip out any political bias?
Well, yes, if you're going to raise your inflation call, don't be cutting interest rates, right? You've been missing your inflation target for quite some time now. People could kind of justify the idea of a very slow normalization of rate cuts or of rates down to a level that's consistent with neutral, because there'd be lingering tightening effects going on. But it seems like they're rushing to get to that neutral level as opposed to just kind of letting them, they keep saying they're data dependent, but this doesn't seem like a data dependent move. The data is telling them that maybe they're moving a little too fast, and they're like, well, no, we have to keep moving. So that they've pre-committed to a course of action, and it got them in trouble yesterday.
You said the market is not the Fed's friend, and I wonder how you believe the Fed will look at the market action, why that in some ways doesn't even help them, because on one level, this is maybe what they're looking for, to reduce some of the potential inflationary pressure.
Maybe, but I think if we take a step back and we say, okay, the Fed was decided to cut rates, did they really want tens to behave the way they did, and the impact that that'll have on the housing market? Have they made the economy stronger or weaker by cutting rates yesterday? And I think the answer is they've probably made the economy weaker. They haven't done anything to contain inflation issues. And people are rightly, I think, concerned that they're not being consistent. And it's very hard to read an inconsistent Fed and determine where policy is going to go. Torsten Slok's out there saying they're going to potentially hike rates next year. I've got some sympathy for that view. I don't have a lot of sympathy for a view that they're going to be able to cut rates more aggressively, or that they might even be able to get back down to neutral now. Sometimes if you run too fast at the start, you can't finish the race that you wanted to finish.
So, Drew, this raises a big question about markets, so let's finish on that. People were bullish, very bullish, going into 2025. The average forecast on Wall Street for the S&P year-end next year was north of 6,600. Drew, do you think now that we're compromising the easing bias of the Federal Reserve, now that policy is increasingly uncertain going into next year, there's a reason to start leaning in the other direction? Or do you pick up the pieces from yesterday and keep running with the bull?
I mean, I think there are hints that growth are fine. There's also hints that growth are weak, right? And is weak. I would say on balance, it still suggests the economy still looks like it's in pretty good shape moving forward. But at the same point, it was already kind of a questionable kind of, how much risk do you want to take to get the returns that you're probably going to expect? And I think people have probably dialed up the risk that's going to occur, and they've actually dialed down the returns that they can expect. And so I think we're seeing that dynamic play out.
Drew, appreciate your time, sir. Thank you. Drew Matus there of MetLife Investment Management. I think most equity strategists would tell you we can handle rates at this level so long as growth is pretty decent. But if the problem is something else, if that something counts as inflation, then that's a little bit more toxic, to use a word that you enjoy.
Well, it's a toxic brew if you have inflationary pressures that are a bit too strong and a Fed that pre-committed to rate cuts that some people view as a potential policy error. We now just have two people on the show really hinting at that, given the fact that this seems to be a market with renewed concerns about lingering inflation. Again, the fact that they cut rates and then increased next year's inflation expectations was really a shot across the bow to markets that had gotten maybe a little bit over-exuberant.
Silver lining. Market pricing, given where it is, they've got some optionality that maybe they wanted for 2025. I would say this, though. Adam Posen came out earlier in the summer, said start trying to find that optionality right now for a very uncertain 2025. Adam Posen on a programme with Matus a little bit earlier making the same point. Up next on this programme, Savita Subramanian of Bank of America, Bloomberg's Mike Shepard, former Kansas City Fed President Esther George and former House Majority Leader Eric Cantor. A Bank of England rate decision also just around the corner.
The Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point.
They still believe that they were restrictive and that even with a 25 basis point cut, they maintain that level of restriction.
I actually think they did the right thing. I'm pleasantly surprised they went to 2 cuts next year.
We're not seeing a meaningful dialing back of policy in the months ahead.
They're signaling a pause, but it's also important to remember that by March, the forecast might look a little bit different.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500, attempting to bounce back. Equity futures up across the board on the S&P 500 this morning, positive by 0.5%, following the biggest one-day loss since August on the S&P, the worst Fed day performance going back 20-plus years. On the Nasdaq, the biggest one-day drop going back to July. On the Russell, the worst day of the year so far. Russell equity futures up by 0.5%. If you switch up the board and get to the bond market, 2-year, 10-year up by more than 10 basis points in yesterday's session. We're up to 432 on 2s. On 10s, we add some weight to the move, up another basis point, 452.41. The Federal Reserve reducing interest rates by 25 basis points. They called it a close call. They changed the forecast. They give inflation a hike. They dropped the median dot for 2025 from 4 cuts to 2. And people asked them in the news conference, why are you cutting interest rates at all at the Federal Reserve? Is it about the data? Is it about the incoming administration? They seem confused about 2025, and apparently they're not the only ones. Over in England, in London at the central bank, just deciding to keep rates unchanged, and Governor Bailey saying we can't commit to when or by how much to cut in 2025.
It is a black box. It is a dark room with lots of furniture. People are moving slowly. It is the U.S. It is also the Bank of England. After you saw wage growth that came in a bit higher than expected, Andrew Bailey saying gradual approach to future cuts remains the right approach. And that seems to be the new zeitgeist for 2025.
Let's head out to the City of London and catch up with Guy Johnson for more on this rate decision. Guy, the vote 6-3 to keep rates unchanged at 4.75. Just how close was this one, and how disrupted was it by this week's data?
So Ramsden and Taylor have joined Dingra in calling for the cut. That's where the surprise comes, John. If the Fed delivered a hawkish cut yesterday, in some ways this is a dovish hold from the Bank of England. Rates are remaining on hold, but you've got a vote split that suggests that actually there was a lively debate about whether or not that cut should have been delivered. Bailey talks about a gradual approach remaining the right course, but they are downgrading the growth picture. They talk about the wage story being, or the labour market being largely in balance. You can see what is happening to the pound right now, giving back some ground that was gained a little bit earlier on against the US dollar. The market going into this decision was actually fading moves for 2025. I wonder whether or not that, as with hindsight, will prove to be the right decision. So we are now seeing, traders adding to bets of easing, sees 58 basis points of cuts next year. So that's a slight tick up in terms of what is anticipated. But the UK faces a very different picture to what we're seeing in the United States. John, growth here is weak. Inflation remains sticky. That's a really difficult course to navigate for the Bank of England going forward. A hold today, but feels a little bit more dovish.
Central bankers seem to be scarred by their recent history. I wonder, Guy, how much the reason why they didn't cut was fear of a Liz Truss moment at a time where the UK faces a bit more weakness than, say, the US.
The UK certainly does face, Lisa, a lot more weakness than the United States. If you look at the growth trajectory going forward from here, like on different planets right now. The latest budgets, I think, from Chancellor Reeves did catch the Bank of England by surprise. It has changed the trajectory. It has made them more cautious. There are some inflationary elements come through from that. I don't think there's any great fear at the moment that you're going to see yields exploding higher in the way that we did around the Liz Truss moment. I don't think that's the real risk right now. The real risk is maybe the stagflationary risk, that you do see this weak anemic growth that the UK is delivering right now, with inflation kind of hovering there as a risk. The bank will focus on that inflation risk. The danger that the UK faces right now is that if we see any more growth, that actually that inflation story gets out of control. The UK economy doesn't have the potential to actually deliver much more growth without delivering significantly more inflation. And that's the concern maybe right now. But today, a little bit more dovish. In some ways, today is a nod to that growth risk while maintaining the approach that actually inflation remains the bigger threat.
Guy, appreciate the update, buddy. As always, Guy Johnson out of London. Sterling pulling back just a touch, still positive on the session, but off session highs against the US dollar. Cable down to about 126. Dovish descent at the Bank of England. hawkish dissent at the Federal Reserve, to Guy's point, but one thing in common going into 2025, maximum uncertainty.
That's the reason why we're foggy. We are in a dark room with lots of furniture, as Jay Powell said. We are entering into the abyss of the unknown. A key question is, how much can central bankers get ahead of this? How much are they susceptible to this unknown? Do they have any type of scenario analysis or tests to really look out? And has the equity market fully wrapped its head around the uncertainty that's being reflected in some of these tortured decisions we're seeing from central banks?
Can I torture the analogy just a little bit more and extend it?
Please.
It's not just that the room has got darker. It's not that it's full of furniture. They don't know what room they're in. And that's the big problem right now for this FOMC.
Yeah, they don't know if they're in the kitchen.
No.
They don't know if they're in the bedroom.
Or if they're in someone else's house. They've got absolutely no idea where they are, Bramo.
I need to wrap my head around this.
Seen this multiple times in 2024. Might see it again in 2025. We begin this hour stateside with stocks steady after the Fed struck a blow to this year's rally. The S&P 500 posting its worst session since August, the worst Fed day since September 2001. And the Nasdaq seeing its biggest daily drop in some 5 months. Savita Subramanian with Bank of America staying bullish into New Year. Getting ready for a cyclical inferno. We target 6666 on the S&P 500 by year-end 2025. With cyclicals leading the way, we see more opportunities in stocks than the index. Savita joins us now for more. Savita, good morning.
Good morning.
So much to get through. Let's start with the outlook for next year.
Indeed.
What underpins that? And have you made any assumptions about the changes we could see from the incoming administration?
Well, look, we're not assuming anything about the Fed. We're not assuming anything about, kind of major changes in policy. I think what we're assuming is we see a little bit more of the same. And what that is, kind of a big reshoring effort that's already underway. We're seeing signs of a pickup in inflation. Again, we've been writing about how if we're in an environment that's similar to 2022, what do you want to own, right? Let's say real rates surprise to the upside, which is so far a little bit of the story, right? We've got inflation not completely back in the bottle. We've got potentially, higher nominal growth expectations next year. I think in that environment, you don't want to be in small caps. And I think there's a good reason that small caps sold off yesterday. You want to be in companies that generate free cash flow because short rates are going to remain higher than expected. And you want to be in companies that are more, let's call it inflation protected. So they participate in inflation rather than get hurt by inflation. And that would be, a big cohort of the S&P 500. Cyclicals, some big cap tech companies are well positioned for that environment. I think 2022 was a worse year for stocks overall because we weren't even positioned for the Fed to actually hike interest rates as demonstrably. Think about where we are today. I mean, we're actually in a much better place than we were a couple of years ago, right? The Fed has done a lot of work getting us off of ground zero. We've got latitude to ease our way out of the next soft patch. So, I kind of feel like this is a moment where maybe the Fed disappoints in terms of how easy they are. Maybe other central banks disappoint. But the S&P 500 can handle it. And there are parts of the market that can actually do well in that environment.
The larger takeaway from yesterday to me is the lack of certainty. And I think he's in the workshop that's dark with lots of workbenches around. Exactly. And so it can be a little bit more perilous. And it also is a time of construction. And construction takes investment. Do you like how I'm taking this on?
Nice, keep going.
Thank you. I'm going to keep going. So you have to wonder if companies have the confidence to make investments in their workshops in order to really expand their businesses at a time of maximal uncertainty where policy members don't have a framework to even look at where we are.
Yeah, I mean, I think that was the story of the second half of this year. And we actually saw a meaningful pause in CapEx and planning because of just this binary outcome in the upcoming election. At least we have a result of the election. I would argue we're at a point of potentially more certainty than we were in late October. We have a result. We know who's in charge for the next couple of years. We have some sense of what's going to happen. We know that there's tariff risks, but there's also potential for, becoming an energy exporter again, exporting LNGs. So I think the big surprise next year, folks are expecting stagflation, terrible growth, high inflation. That's a tail event. In fact, what I find interesting is that fund managers, professional money managers, are basically assigning a 50% probability to stagflation. Stagflation barely ever happens. I think there's a better chance of an upside surprise to growth. Think about corporates. Corporates navigate different policies quite ably. We had a period of time where the Fed hiked demonstrably. We had inflation go from negative to 9 to 3, and margins were amazingly intact. So I think that this speaks to companies refocusing on efficiency, on productivity. They're still doing it. They'll get through this. Valuations are high for certain parts of the market, but not necessarily for the average stock. So I think this is an environment where things are going to be okay.
I'm looking at the sectors that you like, financials, discretionary, real estate. Some of these have gotten bid up in the immediate post-election response, and a lot of it was predicated on the idea of rates going lower. Was predicated on the idea that there would be a friendly Fed to cutting rates and potentially an equity market that would continue to go up.
Yeah.
If we don't get those two things, how much does that undermine the argument for these sectors?
I think that consumer discretionary is potentially most at risk of a more hawkish Fed. But when I look at other sectors, when I look at large cap financials, I mean, if we have a steepening yield curve, let's say the short end pauses and the long end continues to rise, which is kind of what we saw, I guess, over the last couple of months. In that environment, I think financials do well. Large cap financials, I mean, let's think about what this administration means. Deregulation is probably on the top of the list, and I think that's one of the positives for financials. And then when you think about just AI, generative AI, and what it can do for cost control in some of these more, kind of professional services industries, I think that is profound for margins. So I don't think the bull cases have gone away. For some sectors, like sectors that are geared to short rates coming down, like maybe more in consumer discretionary, that might be a risk. But again, when you look at the consumer, we're ably employed. Real wage growth is positive. We've got an administration in place that's probably going to lower the cost of energy, which helps that lower income consumer, which is the one area that's really starting to fray. I think it's going to be okay. I think that's the tail risk that nobody's talking about, is that it's actually going to be okay.
You mentioned employment. Can I jump in?
Yes, please.
I remember a note that you put out a few years ago about the labour intensity of the S&P 500. I'm sure you remember the note as well.
I do.
There are some questions about the supply side of the labour market under the incoming administration.
Mm-hmm.
How do you think about that with regards to the parts of the equity market you want to own, the parts of the equity market you might want to avoid?
Yeah, so let's say we get tighter immigration, let's say we get a shorter supply of labor, and that hikes up wages. I think it's a manageable risk because we've already been working in the context of demographics really eating up the workforce. So here we are today. We could see wage inflation increase in certain pockets. I think it's most acute for restaurants, construction, food services, agriculture. Those are areas where you could see a tighter labor force. But think about what those areas are doing. They're focused on efficiency. If you look at restaurants, we've seen the labor to sales ratio demonstrably decline over the last 2 or 3 years. Go into a restaurant, there's less people working and more processes. So I think that's the offset to a potentially tighter labor market. I don't know how you build a house with AI, so that's one area where you could see some problems. There are areas where this will be a margin squeeze, but I don't think it's as broad spread as one might expect.
Things are going to be okay.
Things are going to be
But the number you
okay.
chose was 6666. I mean, people get spooked by that.
I have to
Savita.
explain that. That was basically the idea that we're going from 666 at the market lows. Just tack on another 6. This is a pretty amazing ascent.
What a run it's been. Savita, it's good to see you. It's
Nice.
good to see you. And the run is set to continue, according to the team over at Bank of America. Savita Subramanian of Bank of America, things are going to be okay. Equity futures doing okay, up by 0.6% on the S&P. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Shares of homebuilder Lennar are falling in the pre-market, down more than 10%. The company forecasting new orders for the first quarter that missed analyst estimates. Lennar also announcing plans to spin off most of its land holdings into a separate public company. It plans to seek real estate investment trust status for the new company as it aims to shift to an asset-light construction model. Meanwhile, the International Brotherhood of Teamsters announcing thousands of Amazon warehouse employees and contract drivers in 4 states will walk off the job this morning right ahead of the holiday delivery rush. Workers in New York, Illinois, California, and Georgia will strike after the Teamster Union accused Amazon of failing to come to the bargaining table to negotiate contracts. An Amazon spokesperson said in a statement last night that the Teamsters have intentionally misled the public about union efforts at the company. And a change is coming to postseason college football. The New York Times reporting the presidents of the country's 8 Ivy League schools announced they will allow their teams to compete in the football championship subdivision's 2014 playoff. Since the conference was formed in 1954, Ivy League football seasons have come to an end on the Saturday before Thanksgiving to allow athletes to focus on their schoolwork. Not anymore. That's the Bloomberg Brief. John?
Yara, thank you.
Yeah.
You know, like,
I got nothing.
Anyone outside of Ivy League care about that? Like, to me, it's like, and I'm going to offend some people, like, to me, SEC football, and then that's like, nothing counts.
Yeah, but there are a bunch of people who are very interested, and for you, I think that's
I'm
wonderful.
a tourist,
You're
and
welcome.
I probably offended a lot of people in the Midwest of this country.
Please, message him.
Don't do that. Up next on the programme, Trump starting a fight on Capitol Hill.
We're going to have to find ways to find savings. Deficit hawks are gone in Washington. They don't exist anymore. And maybe you need the markets to send us a signal. It's time to become more sober in our fiscal outlook.
That conversation up next. Live from New York City. You're watching Bloomberg TV. Equities on the S&P 500 bouncing back here. We're higher. This session high is actually up by 0.6% on the S&P. Bond yields are up too by another basis point or two. That trend continues. Yields keep climbing at the long end of the curve on a 10-year and on a 30-year. The 10-year maturity, 452.81. Under surveillance this morning, Trump starting a fight on Capitol Hill.
We're going to have to find ways to find savings. Deficit hawks are gone in Washington. They don't exist anymore. And maybe you need the markets to send us a signal. It's time to become more sober in our fiscal outlook. There's enormous optimism about the U.S. The economic leaders that have been put in place, the personnel's policy, have really buoyed that outlook. But ultimately, how will these different policies be put in place?
So here's the latest this morning. President-elect Donald Trump opposing a proposed government funding bill and threatening to oust Republicans who accept the legislation. This just days before funding is set to expire, raising the likelihood of a government shutdown. I'm pleased to say that up from the nation's capital here in New York City, Bloomberg's Mike Shepard joins us now for more. Shep, good to see you.
Great to see you.
Can we start with the basics? And you're the perfect guy to do the clinic. A continuing resolution. Tell me what one is and what that is that they're trying to pass down in D.C.
So it's essentially the same thing. They are trying to pass what's known otherwise as a stopgap spending bill. This would tide them over for a couple more months so that they can negotiate a little bit further. The funding authority for the fiscal year was supposed to have begun on October 1st, and they should have well before passed this legislation, gotten it done by September 30th. They ran up against that deadline, so they passed the temporary bill. That expires at midnight on Friday. So now they have to do another one, and the idea with this bill is that it would tide us over until mid-March.
So
March
what makes
14th.
it so controversial if you imply it's business as usual?
Well, it's not so controversial except to the president-elect and to some of his closest advisors, including Elon Musk, who is leading this Department of Government Efficiency initiative that's aimed at slashing the size of government, slashing government spending. And they together took aim at this bill yesterday on X. And then the president-elect followed up with Vice President-elect J.D. Vance saying, we don't like this bill in its current form. Republicans should reject it. Now, keep in mind, they have spent weeks, if not months, negotiating this, and they have been really on track to pass it in time to avoid a shutdown that would take effect early Saturday morning. So this is more than just a monkey wrench into the process. It really derails it altogether, and they have to go back to square one.
It was more than 1,000 pages. Mike Johnson spearheaded this. He pulled this together. How much does this imperil his leadership at a time where he got everybody together just days ahead of the deadline and bam, thrown out.
Well, it's not great, Lisa. And we talked to Ralph Norman last night for Balance of Power, and he is one of the conservative Republicans whose vote Johnson would need to be able to regain the speakership when they hold new elections for leadership when the new Congress is seated in early January, on January 3rd. And those kinds of doubts are being fueled even further by this move by Trump and by Musk. Who is calling the shots in Congress? Is Donald Trump putting the arm on Johnson in a way that undermines his authority with lawmakers? And it makes it complicated for him to then go back to members and say, hey, you know that deal we just negotiated? I'm really sorry. We have to unravel the whole thing now at the last second because the president told us so.
What struck me is it's one thing to have these grand proclamations about efficiency and getting things under control. It's another thing to work within the confines of a complicated system and an existing behemoth that is needing to chug along in order for people to get the services and be employed at the places they are. At what point does this create a certain level of dysfunction that some people in Washington, D.C. are concerned about, whether it means government shutdowns, whether it means potential confusion over certain funding for specific programs?
Well, Lisa, you hit the nail on the head. This really actually accentuates the dysfunction that they are saying that they would want to try to undo or reverse. For example, the spending bill, more than 1,000 pages, it does provide a lot of critical services and funding for initiatives that a lot of Americans would agree are necessary. For example, the package also includes, in addition to agency operations being extended that would keep the government open, it also includes disaster relief, it includes aid for farmers, and a lot of people out there in the public would also want to see that get through. And that is being imperiled by what we're seeing in the process right now, a process that has been unraveled by the intervention of the president-elect. Remember, he's not even president yet, but as the de facto head of the Republican Party, the incoming commander-in-chief of the largest economy in the world, his word does carry some weight. And he's also making some threats to Republicans who decide to cross him and continue to vote for this package or support this package, and do so by funding opposition to them in primary elections 2 years from now.
This might be a silly question, but where is Joe Biden?
Well, very good question, actually, because he is still president of the United States. His signature on spending legislation is valid.
The fact we even need to sit here and say that.
Yeah.
How different is this transition to transitions before?
Well, it's in a way it is different in a sense because we see Donald Trump really inserting himself onto the world stage and onto the stage in Washington in ways that incoming presidents haven't before. He does bring the benefit of knowledge, having served as president for 4 years previously. But in this case, I think the Democrats are looking at this dysfunction and maybe sitting back and watching. We saw Hakeem Jeffries yesterday put out a statement. Look, we have a deal with Republicans on spending. We have the bill text. We expect the party and Congress to abide by it and then put the onus back on Trump and Musk and the Republicans in Congress to actually get done what they had agreed to.
Shep, it's great to see you and good to have you in New York. Thank you, sir. Mike Shepard there of Bloomberg on the latest. If the honeymoon was ever started, it's over for the likes of Speaker Johnson. It really is over. And I have to say this, business as usual in Washington, D.C. is controversial to Mar-a-Lago, and they're trying to change it.
This is true. However, trying to change it by torpedoing a bill would mean that if they can't get anything together and Mike Johnson can't really gain any sort of consensus, then you get a government shutdown, and that could lead to higher yields, and that could lead to this idea of greater uncertainty. I mean, you have to wonder at what point this filters into some ramifications that Mar-a-Lago would not be happy to see.
Got higher stocks this morning. Stocks up by 0.75% on the S&P. That's the bounce you might have been looking for, waking up this morning after the biggest one-day loss on the S&P since August, following yesterday's Federal Reserve meeting. Coming up, we'll catch up with the former Kansas City Fed President Esther George as the FOMC signals a stronger focus on inflation. Live from New York City, you're watching Bloomberg TV. Some relief here. We've bounced back. Session highs up by, let's call it 0.7% on the S&P 500. This is what Peter Cheer, though, wrote after that Federal Reserve meeting yesterday. Positioning has been so aggressively bullish on stocks that it might be easy for the Grinch to steal the centre rally. Lisa, you've said this repeatedly this morning, and I think you're right to point this out. We've compromised the easing bias at the Federal Reserve. I don't know if that puts the Fed put into question completely, but certainly we've made a move in the last month.
And that's one of the underpinnings of what some people call froth, the rally, nonetheless. I have a couple of questions on a bigger level. First, is this the capitulation that people needed to see before they go back in, which is what you're seeing this morning? And how much really is skewed by the fact that it's pretty low liquidity? A lot of people don't want to be here today. A lot of people have already gone on vacation. Is that part of some of the big swings that we've seen as well?
A lot. Do you want to translate
No.
who a lot of people are?
No, I don't. Carry on.
Okay, don't. All right. 2 hours away from the opening power. Let's get you some morning movers with Matus Cranny. Hey, Matus.
Jonathan, I'm still here. The Grinch arrived for Micron when it comes to understanding what's going on in the chip market. This is the personification of a miss, $1 billion miss for the second quarter through to February. So they're going to deliver $7.9 billion. The theory is that the AI chips part of the business is going to save them into the second half of next year. That's a bit like waiting for Godot. The PC market will grow by 5%, be rest assured on that. But this is a miss of about 12% on weaker smartphone, weaker PCs, and weaker autos. That's you, me, Lisa. Smartphone, autos, and PCs. I still don't have a car. But anyway, the data center business did grow by 400%, but it's not enough to invoke any upside in that this morning. Let's roll it forward and have a look at Lennar. Now, the house builders took a pretty bruising day yesterday overall in the market. Lennar is down 9.55%. Yes, there's supply constraint. Yes, we have demand. But affordability is limited from higher interest rates. There you go. And we may be going into an extended pause. Adam Posen told me that this morning. If not, into a hiking cycle. Margins, we can't give you guidance for the back end of next year. They're going to be around 19 to 19.25, but they cannot guide for the full year ahead. I'll leave you with a snapshot of Tesla. Yes, they've bounced back. Yes, yesterday was a pretty brutal day for them, up 3.8% this morning. But in Europe, their registrations fell by 41%. This is a company that promised you 500,000 cars in the quarter. They've never delivered 500,000 cars in any quarter. So that's just a little bit under the hood of what's going on with Tesla. By the way, you know, registrations of electric vehicles in Europe is down 10%. But Tesla, down 41% on registrations. Jonathan.
Hey, Matus, appreciate it. Tesla this morning up by 3%, getting hammered after that Federal Reserve decision yesterday, though still this month up big time. Under surveillance this morning, House Majority Leader Steve Scalise saying the latest stopgap funding measure is dead and a new deal is yet to be reached. This is President-elect Donald Trump says he wants GOP lawmakers to include a debt ceiling increase in whatever package they advance. I want to continue the conversation we had a little bit earlier on this hour, described by people inside Washington as business as usual. And when you get them to really tell you what business as usual actually is, and you hear it, that is why people are so annoyed with Washington, D.C., because this, to me, to you, doesn't sound like business as usual at all.
Well, business as usual consisted of Mike Johnson adding at the last moment an additional $10 billion of aid for farmers. And then in return, others, in particular Democrats, were saying you need to have the control of the RFK Stadium in a certain district transferred to Washington, D.C. You need to have a pay raise for members of Congress. You need to also have another round of federal fundings for the bridge in Baltimore. Look, you could make an argument for any one of these potential issues. The point being is that what are we actually trying to do, and how do we do that in the most direct way possible? That is not business as usual in Washington, D.C.
This is not what a lot of people voted for. They voted for a change, which is why their so-called business as usual is controversial, which is why the incoming administration wants to do something about it. And you and I both said this in the previous hour. This is a huge problem. And it's going to be a really big challenge for the incoming administration to do anything about it. There is an addiction to doing these things in Washington, D.C. They just believe it's normal. And then they all get on board and have their own pet projects because they want to secure their own political future and stay in office. And that's not what the people of this country want at the moment.
And a lot of it is because there's not necessarily the appetite to have real debates or real issues which are exposed when there isn't a whole lot of hair around different bills. And that's essentially the business as usual that they're going to try to grapple with. it's going to be an interesting year.
More on that story throughout this morning. Let's turn to this one. The Supreme Court says it will expedite hearing TikTok's challenge to a law that would ban it in the US next month. The court's scheduling arguments for January 10th, a little over a week before the ban is set to begin on January 19th. So that's quite a start to 2025 for that company.
Especially since the day after that is the inauguration for Donald Trump. So where will he fall on this, given the fact that he has seemed more amenable to the idea of TikTok remaining in operation in the United States of A.?
Another controversial corporate story as well that we need to squeeze in. Reuters reporting the Nippon Steel $14.9 billion takeover bid for US Steel is all but dead. A letter reportedly written by the Committee on Foreign Investment in the United States setting the stage for President Biden to block the deal. CFIUS has until Monday to approve the deal, extend its review, or recommend that the president should kill it.
On a larger level, I just hope that we can get under grips what it means to have national security concerns and really get that under control, because there are some real national security concerns. And right now, I don't have a clear sense of what they are. And I don't get the sense from bankers that they really understand either when they're talking to different companies.
We spent a lot of time talking to Anne-Marie about this. It's a big problem. CFIUS should not be a political wing of the government. It should be about national security risk. Just get the feeling that over the last few years it's become highly, highly political, in line with the objectives of whoever's sitting in the White House. I think that's a problem. If you truly believe there is a national security risk associated with a company operating in this country, we need to do something about it. And do something about it fast.
Yeah, and honestly, that has a bigger question with the likes of TikTok, say, than U.S. Steel, by all accounts. And
sure.
So there's a lot of, consistency questions that a lot of people are raising.
One company is from a country who is an ally, and one company is from a country who is not. Sometimes it's as simple as that. That's the latest on that front. Let's turn back to the Federal Reserve. FOMC officials seeing a higher risk of inflation with new White House policies on the horizon. Fed Chair Jay Powell likening the central bank's path as walking into a dark room full of furniture. It's a shift from last month's message on recalibrating monetary policy. The former Kansas City Fed President Esther George writing, the rationale for cutting today is a little puzzling, notwithstanding it was expected given the forecast for inflation. Esther joins us now for more. Esther, wonderful to catch up with you. You've been on that committee, you've lived it. How bizarre was yesterday for you, just seeing the decision, looking at the forecast and listening to the news conference?
Well, good morning. I do think it's a challenging time, as the chairman said. A lot of uncertainty is in the picture right now. But with inflation persisting above the Fed's target, and I think the FOMC has been very clear, they're not deviating from that target, it raises the question of how well this recalibration was positioned going forward. And I think we heard that yesterday.
Esther, what does it mean when they say they're not deviating from the target, but in practice they're lifting their inflation forecast and pushing out the date for the goal to actually hit the target? What does that really mean?
Well, I think it means the Fed understands its credibility is based on a commitment it made to 2% inflation. And we're now going on 4 years of a much higher level of inflation. And what I heard yesterday is confidence is not quite as strong as it was even 3 months ago, that achieving that 2% target in a reasonable time was in sight. And remember, this is so important because of inflation expectations. The longer the FOMC takes to achieve its 2% target, the more risk, I think, that comes around those expectations being unanchored.
Esther, do you think that it was the wrong decision then not to just remain on hold in this previous meeting, given the fact that essentially there was a good argument not to cut rates that Jay Powell himself made?
Well, I would have been comfortable with that, Lisa, given how we've seen the data come in. Remember, throughout this period of talking about restrictive rates, we've in fact seen the economy flourish. We've seen GDP come in above trend. We've seen the labor market remain stable. And inflation, of course, sticky. So those conditions, I think, obviously raise the question. And the Fed acknowledged it yesterday of saying we may have to be a little more deliberate here as we talk about a recalibration.
Esther, I was struck by the fact that I was looking for clues in Jay Powell's speech about how far we were away from neutral rates, how restrictive he really believes that we are. And he said two different things in the same press conference. He said at one point, we're not that far away from being at a neutral rate. And another level saying we still have fairly restrictive rates. Were you left just as confused about where the Fed lies when it comes to understanding what neutral they're looking for?
Well, I think the chairman has said this before, and it's true. They do not know what neutral is today. And so they are feeling their way. And the challenge, of course, is their most direct influence is on that inflation number. And obviously, they do not want to unseat a growing economy. They do not want to hurt the labor market. That's part of their mandate. But it is true that they must bring inflation down. And I think this pause, if it turns out to be a pause, is one that's warranted, given the fact that inflation has not returned to their target.
Esther, there was also a question about the politics surrounding this, the fact that a number of different members did take into consideration the potential for Trump policies to be inflationary. How much does that color your view of inflation, the stickiness? How much does that concern you about the political ramifications for the Federal Reserve?
Well, I think to begin with, we see an inflation problem aside from any policy changes that may lie ahead. In terms of thinking about your risk and where the risk lies, of course, you have to take that into account. And as you and I have talked about before on this show, one of the differences between now and what we saw in 2017 as the FOMC contemplated tariffs, for example, is that you're approaching your inflation target from a different place. And so that does raise the risk that have to be thought about as they go out. And we heard yesterday people had approached their dot plots in different ways around that. So I wouldn't take that as the sole reason to be concerned. But I do think the Fed has to reiterate its commitment to its inflation target.
Esther, you lived it. And you've been part of that process quite a few times where you've had to put a dot out there, put some forecasts out there too. What was your approach? And why did you think that was the best approach? Do you take notice of the incoming administration? Do you wait for the policies? What was your approach?
So my approach, Jonathan, and this is a difficult process for anyone that does forecasting, is to try to follow some kind of a rule to make sure that you are being consistent in how you take in data and how it might adjust. Certainly, when you're thinking about the balance of risk, though, you have to look ahead. And you have to say, are we coming into a period where it looks like we will be softening? Does it look like we are continuing to have a healthy economy? All of those factors affect the look ahead that influences what dots you're putting down for those out years. Completely imperfect, of course, but necessary to communicating how policy might unfold.
Thank you for sharing that clarity with us this morning, Esther. Enjoy it as always. Esther George there, the former Kansas City Fed president. I think that leads us to where we were a little bit earlier this morning, Lisa. His approach to the November news conference set himself up for failure in the December news conference. When he came out and said, we don't assume, we don't speculate, we don't guess, to follow that up a little more than a month later, to acknowledge that some people do basically speculate, assume, guess about incoming policy. He used a very different phrase to basically describe what I've just said, but ultimately that's where they ended up at this meeting. Some did, some didn't. I'd love to know who did and who didn't, because I'd like to know what their policies and what their forecasts would be if they knew what the incoming administration was actually going to do.
Yeah, this goes back to exactly to Esther George's point. What are the models they're using? What are the scenario analysis? I keep repeating that, and I know I sound like a broken record, but at a certain point, it's okay to bake in some assumptions. In fact, that is the job. The question is, how do you do so? And do you have a consistent way of doing it that can strip out some of the potential fervor from certain data points and market responses?
Stocks are doing better this morning. On the S&P, we're higher by 0.75%, a bounce back there, but not an unwind of the move we're seeing at the long end of the curve. Yields up yesterday, up again today by 2 basis points on 10s to 453, on 30s back through 470. Coming up tomorrow, look out for this. San Francisco Fed President Mary Daly joining this program, 7:30 Eastern Time. You do not want to miss that conversation. 30 minutes right here, live on Bloomberg TV. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Howard Lutnick is stepping back from running Cantor Fitzgerald. The announcement coming as he prepares for confirmation hearings for his role as Commerce Secretary under President-elect Donald Trump. Lutnick has yet to name a successor to head Cantor or the parent company, but his son Brandon, who was a trader at Cantor, will take over as CEO of the company's mostly recently created SPAC. Meanwhile, philanthropist Mackenzie Scott gave $2 billion to nearly 200 organizations this year. That brings the billionaire's total giving over the past several years to more than $19 billion. According to a statement on her website, about 75% of the groups receiving donations support the economic security and opportunity of people who are, quote, struggling. And a Florida county board has approved borrowing for the Tampa Bay Rays' proposed new stadium. The MLB team will receive more than $300 million worth of bonds from Pinellas County, with the Rays and their owner, Stu Sternberg, providing $700 million in addition to being on the hook for all cost overruns. It has been a difficult journey for the Rays to secure a new stadium in the Tampa area, which was only complicated this fall by damage created by 2 hurricanes to the team's current home. That's your Bloomberg Brief. John?
Yahara, appreciate it. More from Yahara again in about 30 minutes. Up next on the program, Speaker Johnson's uphill battle.
We got to get this done because here's the key. By doing this, we are clearing the decks and we are setting up for Trump to come in roaring back with the America First agenda.
That conversation up next. Bouncing back, session highs on the S&P 500, higher by 0.8% on the S&P, and the bond market yields higher by a single basis point, 452.61. Under surveillance this morning, Speaker Johnson's uphill battle.
Vivek and I talked last night about almost midnight, and he said, look, I get it. He said, we understand you're in an impossible position. Everybody knows that. Remember, guys, we still have just a razor-thin margin of Republicans, so any bill has to have Democrat votes. They understand the situation. They said, it's not directed to you, Mr. Speaker, but we don't like the spending. I said, guess what, fellas? I don't either. We got to get this done because here's the key. By doing this, we are clearing the decks, and we are setting up for Trump to come in roaring back with the America First agenda.
So here's the latest. President-elect Donald Trump and Vice President-elect J.D. Vance opposing a bipartisan deal to temporarily fund the U.S. government and avoid a shutdown, writing, Republicans must get smart and tough. If Democrats threaten to shut down the government unless we give them everything they want, then call their bluff. Former House Majority Leader Eric Cantor joins us now for more. Eric, good morning.
Good morning.
How difficult is it going to be to change the establishment in Washington, D.C.?
Well, you know, you're beginning to see, I think, a taste of what is to come over the next 2 years, because this is just a real desire to want to, you know, sort of clean up shop and to get on with a much cleaner, more focused pro-growth agenda in D.C. And, you know, the problem is, even on these spending bills, if Republicans have majorities in both houses, which will be the case in January, you still are relying on Democrats to get things done, given the rules in the Senate. And, you know, when you see the activity online from Elon Musk and then the follow-up from President Trump, you know, it makes it really tough. I mean, because it defies the bipartisanship that is needed to get things done.
But spending taxpayers' money shouldn't be easy. It should be tough. And that's the problem that a lot of people have got with this. They'll use technical terms like continuing resolution. This is just business as usual. Then Lisa goes through all the other things that are stuffed into it, and the general public sits there and says, what's this about?
Right, and I think that's where certainly the objection came from Elon Musk and others, to say, wait a minute, if this was a continuing resolution, which is just a stopgap measure, then let's just get over the hump so the government can continue to operate, but let's not do anything else. And this is the difficulty. When you've got a margin the way you do in the House and Speaker Johnson's dealing with, you need the Democrats to help you, because you are not enjoying unanimity on the part of the Republicans. That's the issue.
That said, this was led by Mike Johnson. Mike Johnson started the tit for tat by that $10 billion provision for farmers. Look, there's a bigger issue here, which is that ultimately some of the bigger conversations about entitlements, about certain health care issues, about other big policies people aren't willing to have in an honest way. How much do you think that that ultimately is the question? So you've got to kind of gussy everything up with all of these, cute little tricks and get something through to just not do anything.
Well, the discussions that they're having around this continuing resolution bill are what's called discretionary funding. It is not what you're saying, the entitlements. And that, as you rightly point to, that is the real problem, and it's causing disproportionately our deficit and the growing debt. There's no question. But President Trump has said we're not touching that. Now, what I hope is with Elon Musk and Vivek Ramaswamy overseeing this DOGE effort, although it's not technically part of government, it can have a lot to do with the actual debate on policy. And I hope they're going to come up with something to define the debate. And hopefully it'll be clean up the way that these entitlements work so we can begin to see how we can reform those, because that's going to solve our debt and deficit.
You're at an amazing vantage point, understanding how the sausage is made, having a lot of contacts, and also seeing the business world react and being a part of that. And I'm just wondering how much the efficiency that markets have been rallying on is jeopardized by the dysfunction of trying to fix something that feels very, very broken.
So what I can tell you at Moelis, we are seeing our clients pick up in a big way the dialogue, their deals being dusted off, those that have been put on the shelf over the last several years, in fact, turning into, we've even seen a pickup in the acceleration, if you will, of completion of deals. And I think it's all about the optimism coming from deregulation, the fact that we're going to have an administration that is not an adversary to a pro-growth agenda and to business. And I think that just tells you where we've been in this country. We have had and suffered a negative. It has been almost a war on a growth agenda over the last 4 years under Joe Biden. And so I think that's ultimately going to prevail over any doubts about whether Washington in the end will get something done, because I still sit here today and say they will get something done to fund the government.
Compare the mood to that in Europe. How different is it right now? People are fired up about America into next year and beyond. And by people, I mean consumers. Confidence is up. Businesses, confidence is up. Compare that to Europe right now.
Amazing. And I spent all week in Europe, and it is amazing the difference of being here, looking at the optimism, the momentum we've got. It's reflected in the valuations of assets here. And you can see the unleashing of not only strategics here, but our sponsor clients. Everyone is sort of, you can really feel it. In Europe, everybody's looking here. I mean, that's the amazing thing, because there's a huge difference in valuation between on assets here versus Europe. And you would think, well, that would push people to go look for bargains over there. You've got investors and folks looking here. Everyone's coming here. It is striking. And now look, their political situation also is now the additional stumbling block that they've got to deal with, which doesn't bode well.
Yeah, whatever the fight looks like down in Washington, D.C., I think we should be very clear on a relative basis. The mess is elsewhere. Canada, Germany, France. The list goes on and on and on when it comes to political instability.
And it's not necessarily because those politicians are that much worse than the U.S., but it's that the U.S. corporate sector has managed to outperform again and again and innovate. And ultimately, that's what it's going to have to come back to.
I'll always say this, though. In our country, you look at the size of government as a percentage of GDP. We are much, much smaller, even though we, as a limited government conservative, you compare that to the EU, and they're 50%.
France pushing 60.
Yeah.
Eric, it's good to see you, buddy.
Great to be
Thanks
here.
Happy
holidays.
To you as well. Eric Cantor there, the former House Majority Leader. In the next hour, massive lineup, including the Secretary of State, Antony Blinken.
Some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation.
It feels a little bit like they're prejudging potential policy outcomes.
They did cut at this meeting. If they were front-running policy, they wouldn't have cut at this meeting.
I think today's message was they have less conviction about that downward path of inflation.
The Fed signaling and what we're going to get out of the Fed is just that much more uncertain.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, following the worst Fed day performance for this equity market in 20 plus years. Your bounce back looks like this on the S&P 500, higher by 0.8%. Across the board, you see the move on the Nasdaq, the bounce back on the Russell, the small caps up by 0.85%. We'll see if this sticks. In the bond market, that move did stick. Higher yields at the long end of the curve. It continues up another basis point on a 10-year to 453, on 30s, Bramo up 3 basis points to 470.63.
To me, what really stands out from this morning's analysis is what Esther George said, formerly of the Kansas City Federal Reserve, that she would have been more comfortable with not cutting rates, and that essentially she leaned into this idea that ultimately there was a really good case to not cut rates based on that inflationary pressure. The concern now is, are markets going to think that this is going to be a Fed that was on autopilot and made an error in cutting rates at a time where inflation continues to surprise to the upside?
The question's been asked on repeat. We mentioned Steve Englander of Standard Chartered, who put in his note just yesterday, immediately after that news conference, if you were going to be so hawkish, why did you cut interest rates? It's one thing saying it's a close call. It's another thing cutting interest rates and then boosting your inflation forecast. What gives?
It was a very tortured message, and clearly there was a sense that there wasn't consensus and that everybody was looking at their own ways of modeling out how to judge incoming data. The result is people are questioning whether the Fed put is there, and maybe that's okay, because ultimately if inflation is the problem, then the Fed put is not necessarily on the table. And it also questions how this Federal Reserve and how different members are considering incoming policies, what that is going to mean to their scenario analysis going forward about what the balance of risks might be.
You framed it perfectly earlier on in the program. The easing bias of the Federal Reserve has been compromised. Now, compromised by what is where the debate is for me. Compromised by the incoming data? Possibly. Compromised by the incoming administration? Maybe. Which one was it? And if you ask one Fed official on that committee one question, the same question, they'll give you one answer. Another committee member will give you another. That's problematic for a Federal Reserve chair that's got to go into a news conference and try to offer some kind of consensus. And I think that's where the chairman had some difficulty, and where I'll find just a little bit of sympathy for him.
And the context is important, and I think that this is really what you nailed down, this idea that he said we don't speculate, we don't forecast. Well, actually, you do forecast, but he was sort of so dismissive of looking at what potential policies could look like at the November press conference. It is totally understandable to have uncertainty about policy, to look at what some of the proposals are, to look at the starting point of inflation and make some assumptions. But then don't shut that down, because ultimately the Federal Reserve has to speculate to some degree with their forecasts.
2 days after the election, it was easier to say that we don't speculate, guess and assume, because they didn't have to speculate, guess and assume. They didn't have to put out any forecasts. At the December meeting they did, and we said at the time, December would be far harder for them because they'd have to produce some forecasts and make some assumptions about the future. Where I'm at now, Lisa, is pretty clear. Are they going to be swayed again by one data point? By CPI? By payrolls on January 10th? Are we back doing something else again? Because this Federal Reserve, this committee, has been all over the shop. This market too, but this committee as well. Through 2024, the head fake for inflation of Q1, for unemployment through the summer. And I don't know how you describe this moment, but it's not the recalibration phase anymore going into 2025.
No, this is the foggy room, dark room with lots of furniture. Andrew Hollenhorst of Citigroup still thinks that this is a Fed that capitulates with many more rate cuts next year if there is incoming data, as he expects, that shows a labor market weakening at a much faster pace.
Equity futures bouncing back. We're higher by close to 0.9%. That's quite a bounce on the S&P following the biggest one-day loss going back to August. That's the equity market. In the bond market, yields bleeding a little bit higher through 450 on a US 10-year. Through 450, I believe, for the first time since May. Haven't seen these levels for quite a while. The 10-year at the moment, 453.21 and up by a further 2 basis points. Coming up this hour, we'll catch up with Darrell Cronk of Wells Fargo as the S&P 500 looks to bounce back. Secretary of State Antony Blinken as he rounds out his final days in office. And Francis Donald of RBC as the Fed looks to a more gradual pace of easing in the new year. We begin this hour with stocks steady. The Fed denting the market's bull run, sending the S&P 500 to its worst Fed day in more than 20 years. Darrell Cronk of Wells Fargo saying a January rate cut should not be expected by markets. We look for the Fed to be much more deliberative and remain in a data-dependent holding pattern as it pertains to future rate cuts. Darrell joins us now for more. Darrell, good morning.
Good morning, John.
Are they hyper-data dependent? Is it one CPI print, one payrolls print that changes this story all over again?
I think that's a good question. I don't know that I'd describe them as hyper data dependent, right? I mean, if you looked at the last 4 CPI prints, they've all come in ahead of expectation, right? We put out our 2025 outlook several weeks ago. We actually think CPI ends 2025 at 3.3%, which is well above, almost a full point above where the street is, right? So we do believe, and therefore you can imagine we've dialed back rate expectations as well. So we had in early December, a December cut because we thought they were a go, and then one more for next year and then done. But if you back out of this whole thing, right, remember, we've raised rates 525 basis points in this cycle. Think about how you're going to put this in the history books, right? Then we cut 100 basis points today. So we're literally back to where we were in December 2022, right? We raised 123, we cut 124, so we just round tripped it basically. In December 2022, inflation was 6.5%. Right? Powell stepped to the podium yesterday. He was a little bit of the Grinch, let's call it that, right? But he might have actually delivered a holiday present to investors, right? Because you take some of that froth out of the equity markets, right? We still have a 6,600 target next year. If you get down here around 57, 5,800, you're talking about 16, 17% return to that target. So we think there's opportunity, but we'd be cautious in the very short term. The rest of the year is going to get a little bit wieldy, I think.
You and everybody else, the median price target for next year on the S&P 500 is 6,600. Lisa's made the point repeatedly through this morning. It feels like the easing bias has been compromised.
Yes.
Does that not constrain this rally in any way, shape or form in 25?
I think that's what markets are, wrestling with right now. I mean, think about it. You've taken the short side down 100 basis points, and the 10-year, you've talked about it all morning, has since the September 18th initial cut of 50 basis points, 10 years up 80 basis points. So down 100 on the short side, up 80 on the long side. You've steepened this yield curve meaningfully, right? That matters for equity markets. When you think about equity markets, though, remember this. We're 2 weeks away from year end, right? You step right into 2 weeks ahead of quarter end. What goes away? Corporate buybacks, right? They go into a blackout period. So you lose that buying power out of equities here in the short term. At year end, people are going to rebalance. What are they going to do when they rebalance? They have to sell equities because it's been a meaningful year and buy fixed income if they're just simply doing a stock bond rebalance. So that's at play. Tomorrow's triple witching, right, which is going to add volatility, right? We haven't talked about that at all, right? And then the last point I'd make is, if you look at technicals, right, yesterday we breached both the 20 and 50-day meaningfully, right, in the same afternoon from the 20-50-day wides of the year, basically, right? That's substantial, right? I mean, it's a pay attention sell-off yesterday afternoon. So the next couple weeks we think are going to get a little choppy here.
All I can say is triple witching. I never understand exactly what that means other than it sounds spooky. So if things could happen that are a little bit strange. I do want to get into it. I know there's these different kinds of closing out of different contracts. But
Grandma, we know you know. Don't worry.
No, but I'm not trying to say, but it's always, I'm like, what's the implication of it? Nobody could ever give me a straight answer.
Superior intelligence every time you speak.
Oh, so I'm just dripping with sarcasm. It's okay. All right.
You don't have to clarify.
Stop. All right, let's move on. All right, Darrell, there's this question, as you said, rebalancing into bonds and stocks at the end of the year. And I wonder what the takeaway is from you that we haven't seen more of a rally at the long end of the yield curve. I mean, that to me signals that people are truly worried that this Fed has lost control to some degree and that they cut even though they do see increased risks of inflation on the horizon.
Well, okay, so let's unpack that for a second, right? The long end of the yield curve is a term premium, an inflation premium, and a growth premium. That's basically what it is, and they ebb and flow and move. If I say, U.S. GDP in the fourth quarter is going to close here with a 3 in front of it, and it may be after retail sales at 0.7 this week, maybe as high as almost 3.5%, and then take at least our expectation for a 3.3% inflation, right? Nominal growth is north of 6%. In that environment, right? nominal growth matters, right? Because it's what corporate revenues and earnings are priced in. So it doesn't shock us at all that the 10-year's at 4.53 this morning. In fact, we said rates are going to be higher next year. Where we've been out of consensus, we think growth is stronger, rates are higher, earnings are higher next year because of that nominal growth, right? And so we found ourselves here as we turn the page a little bit out of consensus, but we're okay with that, and actually the markets are coming to us.
At what point does this leave the dollar in a precarious situation? I mean, really, this is something that John was asking about earlier, and I think it's a really important question at a time where it's been climbing and pressuring all the other economies of the world.
Well, I mean, so when we put out our outlook, literally just weeks ago, we had 107 to 109 on the Dixie, right? It said 108 or 107.9 this morning. Everybody laughed at us when we said it was 108, 109, because they said, the dollar's already come too far, too fast. Here it is, right? I do think it's curbed from here. I don't think it gets much above 109, 110, but the fact that it stays there, right, and just grinds on particularly weak emerging markets, I think does matter, right? And it's also a point of fragility of if you get higher rates and stronger dollar, that just really is hard on global economies, right? We already know it from developed, Japan, Germany, everybody else, but it's meaningfully hard. What you don't want to have is strong dollar break a weak emerging market in this kind of environment. That's where it becomes problematic.
I'm just wondering, next year you think growth is going to outperform, you think that you're going to get good returns from equities. What concerns you now? Does it seem like there is a bigger risk to an upside surprise for inflation,
yes,
or with the given shift in the Fed, that potentially there could be a downside shift to growth?
The former, right? I mean, I think you nailed it. Everybody wanted to talk about, with the incoming President-elect Trump, a fiscal moment, bond vigilantes. I think the real surprise next year is inflation ends up higher and meaningfully higher. Again, if you use the consensus at 2.4, right? That's where the street is today. Like I said, we're at 3.3. We're almost a full point ahead. That's a game changer for how markets have to reset from here. We're not pricing in that expectation.
Markets were okay with inflation. Then we should reflect on that.
Right.
Top line revenue growth was decent. Companies had pricing power. Is this the kind of inflation that would be different, that companies would struggle with? Have we reached a tipping point for pricing power, for consumer price tolerance?
Not yet, right? Because again, I think with that strong nominal growth, but it is going to be harder on consumer-based companies to put that pricing power in, right? I do think you'll get it out of, industrials, financials, those types of places. But the consumer discretionary and/or to a lesser extent consumer staples, I think the pricing power is a little bit capped, if not dead in the water.
That's got to be the big debate, Bramo, going into 25. If you get that inflation, okay, we've lived with that. It's terrible for consumers. Right. It's bitten really, really hard. But corporations had pricing power. And you saw that top-line revenue growth. You saw that strong nominal growth reflected in higher equity prices. Do you get a repeat of that? Or is this time different?
This to me is the key question. And do you get a repeat of that in the same industries? Or do you get a repeat of that maybe in the goods sectors at a time when the services sector saw the biggest inflation? That's one of the reasons why this has been so difficult. The different pistons of the economy that are firing, not in sync, that really create a muddy picture.
Darrell Cronk of Wells Fargo. Darrell, good to see you.
You too.
Merry Christmas, sir.
You too.
Enjoy the holidays. Thank you. Thank you very much. If you are just joining us, equity futures here by 0.8% on the S&P. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. House Majority Leader Steve Scalise says the stopgap funding measure is dead. The announcement coming after President-elect Donald Trump came out against it, threatening to oust fellow Republicans who don't meet his demands. Elsewhere, the Bank of England holding rates steady, the central bank signalling it will keep easing gradually in 2025, despite a growing minority of officials advocating for an immediate cut in borrowing costs. And finally, Formula One driver Sergio Perez is no longer with Team Red Bull, the team ending his contract 2 years early after months and months of poor results. Sergio has not won a race since 2023. His former teammate Max Verstappen has dominated, winning 9 races and his 4th consecutive title this year.
All I can say is we insult Ivy League football. You say the only thing is there is SEC football and F1, and then we do a brief about F1. All right.
Is that okay?
It's fine.
All right. Just wanted to squeeze it in.
All right. Okay.
Call it a Christmas
fine.
gift.
Merry Christmas.
Thank you very much.
Anytime.
Up next, the Morning Calls Plus, an interview with the US Secretary of State, Antony Blinken. That's just around the corner from New York. This is Bloomberg. The opening about 1 hour and about 13 minutes away. Equities are higher by 0.8%. Let's get you some morning calls. First up, Jefferies upgrading Tapestry to buy, expecting continued momentum from the Coach brand. Your second call coming from TD Cowen, raising its price target on Boeing to 200, pointing to dramatic free cash flow growth potential. That stock is up by 1.5%. And finally, Bank of America downgrading Micron to neutral, highlighting weak PC and phone market trends. That stock getting hammered. Haven't talked much about it, Bramo, this morning. That stock is down by more than 12%. For the broader market, equities are doing better. We're bouncing back. We're higher by 0.8%. A big one-day loss yesterday, the biggest one-day loss on the S&P 500 going back to August. The worst Fed day performance we've seen on the S&P. Found this stat absolutely stunning. The worst Fed day performance in more than 20 years.
Yeah, well, ultimately, you raised this question going into this. Only one meeting did we see bond yields, we see the market sell off so far this year during a Fed decision. This time was different, and oh boy, was it different. And it raises this question of, does this signal a real shift, or is this just simply a market that got upended at a time where there was a bit of froth and not a lot of liquidity?
We've got an important conversation coming up very shortly with the U.S. Secretary of State, Antony Blinken, sitting down with Bloomberg's David Gura, so stand by for that. I think we need to spend a little bit more time speaking about the Federal Reserve. This easing bias has been compromised, I'm with you, and I think that's what really spooked this market yesterday. And you could sense it at the very beginning of the news conference when Chairman Powell was asked, why cut interest rates? We're looking at your forecast. You've raised the outlook for growth, for inflation. You've dropped the outlook for unemployment. Why cut interest rates at all today? And he used this phrase and said it was a close call. And then when you dug a little bit deeper, what was behind the forecast? And you started to find out things like some people included the policies of the incoming administration, the uncertainty around them, and some people didn't. And you start to wonder, well, what would the forecast look like if they all did? What would the forecast be for interest rate cuts in 2025?
There are a lot of questions about how Fed Chair Powell, who has enjoyed consensus for so much of his tenure, handles dissent. Handles the idea that we're not necessarily seeing any cohesion with respect to the scenario analysis, the modeling, or what people think and expect for next year. And that's really creating a lot of uncertainty in markets that have equal uncertainty. So that, to me, I guess my question is, why did the market sell off so much? Was it because of that confusion? Was it because they cut rates at a time where they're still worried about inflation? Or was it the incorporation of theory from the potential Trump administration?
I always say this, it might sound a little too philosophical, but to work out where you're going, you've got to think about where you're coming from.
Correct.
We were pretty extended. We were talking about 12 days, now 13 days of negative breadth on the S&P 500, just one small part of the stock market doing the heavy lifting. We'd seen a massive run across a lot of assets. Lisa, you've seen the moves in the stock market and crypto on stocks like Tesla, single names that have had massive moves over the last month. It doesn't take much to spark a big unwind, and I think that's what we got yesterday. But we've said this a few times about Chairman Powell. Set himself up for failure. When you come out in November and say you don't speculate, assume and guess, and then you have to put out some forecasts a month later where you have to speculate, assume and guess. I don't think it gets any easier when we get to January. I don't think it gets any easier at all. We've got to figure out what this administration is going to do. We've got to figure out the consequences that will have. And as you heard from Eric Cantor a little bit earlier on this morning, Eric's making the point that people are fired up to invest in the United States of America and this economy through the next year and beyond. Never mind what that means for inflation. What does that mean for growth?
Ultimately, a lot of people are upgrading that. And really what Esther George said, I thought was really telling. It's not just about what the potential policies would do. It also has to do with where we're coming from and how much inflation's already in the system. And that, I think, was the biggest key. The inflation that they're recognizing already being in the system, heading into potentially an expansionary moment.
The difference, though, looking at 12 months compared to where we were 12 months ago, looking out a year, when we had the median year-end target on the S&P of 4,800 and then closed north of 6K in the last few weeks. And now everyone, I sense there is this real career risk associated with being bearish for 2025, which is why we have basically an average target on the S&P for year-end next year of 6,600. No one wants to miss it to the upside. That's a big change.
It is a big change, but it included the tailwind of a Fed with an easing bias. If that gets removed, how much does that change the outlook for next year? That, I think, is really what, for a moment, for a hot second, people were evaluating. And to me, I'm curious to see if this lasts, right? You could say low liquidity. You could say we were just taking froth off the top. But can we really say that if it continues into the beginning of next year?
Let's get you that conversation that we promised you. Joining us now with David Gura, the U.S. Secretary of State, Antony Blinken. We'll head over to you.
Thank you very much, and welcome to our audience on Bloomberg Radio and Bloomberg Television worldwide. Mr. Secretary, thank you very much for being here.
Good to be with you.
Many ways we could go here, but let's start with Syria. And you've described this moment as one of both promise and peril.
That's right.
You have what seems like a de facto government that is a designated terrorist group, and you've said that the U.S. has been in contact with HTS. What specifically have they said? I know there are other groups operating in the country as well, but what have they said about how they might govern if this is how it all shakes out?
What we've heard them say is positive. The question is, what are they actually going to do? We brought together with Jordan countries from around the region last week. We had Turkey, we had Iraq, we had the Gulf states, Jordan, Egypt, European partners. And we came together to set expectations. What is the international community? What are the neighbors looking for as this transition takes place in Syria? And we all agreed. We want to see something that's inclusive, that's non-sectarian, that respects minorities, women, that deals with any chemical weapons that may be remaining in Syria, that doesn't ally with ISIS or any of the terrorist groups that are there. And the reason that's so important is we want to make it clear to HTS and all of the emerging authorities that the recognition that they seek, the support that they seek and need from the international community, well, there's certain expectations that come along with that. And as I said, we've heard positive statements coming from Mr. Jalani, the leader of HTS. But what everyone is focused on is what's actually happening on the ground. What are they doing? Are they working to build a transition in Syria that brings everyone in? If they do that, and if they meet some of these other tests that the international community is looking for them to meet, then I think you can see something very positive. And here's what it is. For the first time in decades, the people of Syria can go forward without a dictator, without a terrorist group dominating their lives, without one sect or one group running things at the exclusion of others, and without foreign power calling all the shots. That's the opportunity, but it really requires HTS and other groups that are there to move forward in this inclusive way.
You've said that the U.S. wants to help, and I look at this country that has a lot of sanctions that are residual. A lot of sanctions have been in place for decades on Syria. Senator Chris Murphy of Connecticut has called for a temporary suspension of sanctions. Is that something that you would be amenable to, and would that be effective in helping you have more engagement with what may be this new government?
So we're looking at all the authorities we have. We're looking at all of the sanctions, not only our own. The United Nations has sanctions on HTS, its leader. And I think what we need to see is actual concrete steps, building an inclusive, non-sectarian government, a transition, eventually getting to an election. As we see these steps taken, then I think we'll be able to respond. Others will be able to respond. That's what we'd like to do. But we need to see concrete action, not simply positive declarations.
The EU's chief diplomat has said she's sending a senior representative to Damascus to talk to this new group, talk to this government. Is that something that you would want to do, that you can do, indeed, given the terrorist designation and the sanctions that are in place?
We've actually been in direct contact with HTS.
On the ground?
I can just tell you we've been in direct contact. And we're also looking at getting people on the ground in Syria. I think it's important to have direct communication. It's important to speak as clearly as possible, to listen, to make sure that we understand as best we can where they're going and where they want to go. So we'll be looking at pursuing that in the coming days.
Pull back and ask you another question about the region, and there's been a lot of speculation that a ceasefire deal could come together. When President Biden spoke about the deal between Israel and Hezbollah, he was asked at the end, do you think you can get a ceasefire deal by the end of your tenure? He said he's hoping and praying. Is there anything that's happened that gives more grounds for hope and prayer going forward here?
There is. And the reality is we should logically be able to get this. And I say that with all the caution that comes with that statement because, you know, we've been very close before. And we've had these Lucy in the football moments where you're just ready to kick the football and Lucy pulls it away. But what's changed is this. Hamas knows that the cavalry is not coming to the rescue. For months and months and months, it hoped it would get a wider war with Hezbollah, with Iran, with Iranian-aligned groups, coming in and creating more problems from Israel on more fronts and helping Hamas endure. We now know that's not happening. They know it's not happening because of the very important work that was done with us and with others, dealing with the unprecedented Iranian attacks on Israel, dealing with Hezbollah. So I think that's concentrated minds among Hamas on the need to complete this deal. Having said that, you know, it's always incredibly fraught, and it's very hard to get decisions made. It's hard to communicate, and for all of those reasons, even as close as it is, you know, it can still move in the other direction. But we've all been fanning out, working with all of the different partners who can make a difference and who may have some leverage with, communications with Hamas, whether it's Qatar, whether it's Egypt, whether it's Turkey, where I was just last week. The fundamental question right now is Hamas finally prepared to say yes? And if it does, we get the hostages back. We get a ceasefire. We get an immediate, dramatic improvement in the lives of Palestinian children, women and men who've been caught in this horrible crossfire since October 7th of Hamas's making. If they really purport to care about the Palestinian people, they will say yes and do it now.
Let me ask you about that horrible crossfire, and it's something that you've written about in a recent essay for Foreign Affairs, the fact that millions have been displaced, tens of thousands have been killed, Gaza has been kind of reduced to rubble. You've made 12 trips to the region. How much regret do you have that kind of sustained level of humanitarian aid hasn't made it into Gaza over the course of this conflict?
You know, from day one, we've tried to do several things, going back to October 7th. First, to stand resolute with Israel to try to make sure that October 7th would never happen again. Second, to prevent this war from going wider, because if that happened, if other fronts opened up, whether it was with Iran, whether it was with Hezbollah, these other groups, more death, more destruction, and it would probably prolong what was going on in Gaza. And three, to do whatever we could to make sure that people in Gaza were getting the assistance they need, were getting the protections they need. And we have been on this virtually every single day, and we've seen moments when more assistance was getting through. Then we've seen moments where it's ebbed and flowed. But this has a dramatic effect on the lives and livelihoods of people in Gaza. The last week or 10 days, there has been a noticeable improvement, but we've seen that before, and then we've seen it fall off. The best way to finally deal with the needs of the people would be to end the conflict, would be to get the ceasefire, to get the hostages home. That's the best way, because you have an environment that is unique. You have a population that's trapped in Gaza. It doesn't have anywhere to go. In most other conflicts, people, they can become refugees. That's not a good thing, but it's better than being caught in the middle of a hot war. And also you have an enemy, in the case of Hamas, that's fully enmeshed with the civilian population, living in and under buildings, apartment buildings, schools, mosques, hospitals. That doesn't obviate at all the responsibility that Israel has to try to ensure that assistance gets to people who need it, and that people are protected as best possible. And we've been pushing on that every single day. We've also seen what's possible if there's real sustained focus on this. There was a polio vaccination campaign to make sure that little children in Gaza got these vaccines, and it was very successful. Until there's an end to the conflict, what we've been trying to impress upon the Israelis is the need to bring that same focus in a sustained way on getting assistance to people who need it.
Ask you a last question just about the transition that's underway, and you've said of this new administration, you want to pass the baton to them so they can get off and running. Forgive me, but it does seem like they are off and running. You had President-elect Trump meeting in France with President Zelensky, President Macron has met with Prime Minister Trudeau in Florida. His designate to be the special envoy to the Middle East has been in the region as well. Does that complicate the work that you are doing, having that sort of separate voice, separate foreign policy, for lack of a better word, in the region while you're trying to do your work?
Look, there's one president at a time, one administration at a time, but we're in very close contact with the incoming administration. I spent a couple of hours.
It does feel novel, though. I mean, we used to talk about the Logan Act.
Yeah.
It does feel like these are different circumstances.
Look, I think there are a few things. I think there are a few things going on. First, as I said, we've been in very close contact with the incoming administration. I've spent a lot of time with Senator Rubio and Jake Sullivan, the National Security Advisor, with Mike Waltz, his successor. We've had very good, not only conversations, but we're trying to make sure that we're as coordinated as possible so that they know what we're looking at doing in the remaining time that we have. I want to be able to hand off to the incoming administration the best possible hand to play in all of these areas, in all of these challenges, because the world doesn't stop just because we're in a political transition. It's also normal that countries around the world want to hear from the incoming administration. They want to know what they can expect, and so they can get ready for that. As long as we're communicating closely, which we are, and as long as we're working to, again, try to make this handoff as effective as possible so that they can get moving on the run, because there's really no time to wait, then I think that's a good thing. And look, on the Middle East, just to stick with that quickly, we've been working very hard to make sure that, as best we can, we actually start to implement plans for a better future for the region, or if we don't have time to fully do that, to be able to hand them off. Not just getting the hostage and ceasefire deal, but having a clear plan for what follows, a day-after plan for Gaza, so that there's no vacuum that Hamas can refill, that Israel can pull out, and you can have Gaza stand up for its people. Administration, security, reconstruction. We have done an extraordinary amount of work carrying through what President Trump started with the Abraham Accords to get normalization between Israel and Saudi Arabia, which would be the biggest game changer in the region. And those plans are there and are in place and ready to go if we get an end to Gaza, a conflict there. We've done a lot of work on what a pathway to a Palestinian state would look like when people are ready for that conversation. They're not now. At some point, they're going to have to be. All of that is ready to be handed over to the new administration, and hopefully they'll carry the ball forward.
Very quickly before I let you go, you mentioned that normalization deal. It was something this administration invested a lot in before October 7th. Clearly the conversations have been going on. There has been reporting that we're close to a breakthrough there. Is there? Can you shed any light on sort of where those conversations stand today?
So one of the things I look back on is on October 10th, a year ago. I was supposed to go to Saudi Arabia and to Israel to work on the Palestinian component of this normalization deal. And of course, that trip didn't happen because of October 7th. But even with Gaza, we've continued these conversations, we've continued this work. And in terms of the agreements that are needed between the United States and Saudi Arabia, they're pretty much ready to go. And that would then trigger the normalization between Israel and Saudi Arabia. But two things are required to actually get that done. One is an end to the conflict in Gaza, and two is having a credible pathway toward a Palestinian state. As I said, all of the work's been done, and hopefully we'll get to that end of conflict in Gaza. They'll have to engage the conversation on the answering the Palestinian question, but the work is there. And if that happens, this transforms the region. You have Israel that's integrated in the region. There's a common security architecture to deal with Iran. We saw that, something we put together embryonically when Iran attacked Israel in an unprecedented way, a direct attack. We not only, for the first time, participated in Israel's active defense, we brought other countries, including countries in the region, into that defense. So you can see what's possible in the future. But it requires an end to the conflict in Gaza, and it requires moving forward on the Palestinians.
Mr. Secretary, thank you very much. That's Antony Blinken, Secretary of State. I'll send it back to you.
David, thank you. It is quite a handoff. Two hot wars on the global stage and the most fragile geopolitical backdrop, Lisa, in decades. That is quite a handoff to leave behind.
And there's a question about what the path forward looks like and what happens in the next month as we sort of have this transition process.
Let's turn to the economic data. If you are just joining us, welcome to the programme. Moments ago, we had economic data in the United States of America, including jobless claims. For the latest, we can bring in Mike McKee. Good morning, Mike.
Good morning. Well, you can talk how you want about overseas situations, but the U.S. economy still is the envy of the world. Growth, GDP, the second revision, third release, 3.1% as personal consumption rises to 3.7% from 3.5%. As Jay Powell said yesterday, the U.S. economy is in pretty good shape. Initial jobless claims dropped back to 220,000 from 242, a drop of 22,000. Remember last week we said it was influenced by the Thanksgiving holiday, and that certainly appears to be the case. The Philadelphia Fed business outlook down to negative 16.4 from negative 5.5. We saw something similar with the Empire Index. So it does seem we're seeing a bit of a manufacturing slowdown as new orders there drop to negative 4.3, shipments negative 1.9. Now everybody wants to know what prices paid are. This is interesting. Prices paid go up to 31.2 from 26.6, but prices received fall in half to 7.3 from 14.3. So it depends on which end of the invoice you are on, I guess. And, that basically is the story this morning. The U.S. economy in pretty good shape. The changes in the GDP number, basically personal consumption. We also saw a drop in the level of inventories to 57.9 billion. So that subtracts from growth. So overall, we're nothing to complain about here.
Put it all together, Mike. Retail sales earlier this week as well, pretty decent. The S&P Global Services PMI, pretty decent. Yields push higher. Again, Lisa, up another 2 basis points on 10s, up close to 4 basis points on a session on a 30-year.
Yeah, it raises this question, especially because the sell-off is disproportionately on the long end right now. You're actually seeing 2-year yields come in. I wonder if this is a bond market saying that this was a Fed that made a policy error cutting it all yesterday, especially given the fact that there aren't signs of weakness at a time where they themselves upgraded their inflation forecast.
Some people do share that view. If you are just joining us, we're looking at a bond market with a 10-year through levels we haven't seen since May. Expectations for next year's rate cuts falling after yesterday's 25 basis point rate cut and all the changes you saw in the forecast from the Federal Reserve as well. Francis Donald of RBC writing, there is no consensus, no conviction in this FOMC, so trying to decipher their perspective/bias as a whole is probably a fool's errand. I'm pleased to say that Francis is with us around a table. Francis, good morning.
Good morning.
No consensus. Does that make it pretty tricky for the chairman to offer any particular view for 25?
Very difficult to give his view of what will happen, but not only is there not consensus from the Fed about what is happening right now and what's going on, but where will we be in 12 months? Now, no forecaster, public or private, knows where we're going to be in 12 months. We don't know what policies are coming through, their magnitude, their timing, but we do know the direction of where things will go, and that is that incremental policies will be inflationary and probably drag on growth. And this is why I think this is the problem for the Federal Reserve. It's not higher inflation. The Fed is not afraid of higher inflation. They know what to do. You hike rates or you keep them stable. They're not even afraid of weaker employment. You lower rates. What they're afraid of is a stagflationary environment. And if inflation heads upwards or is sticky for factors they cannot control, supply side, and the unemployment rate rises, or there's weakness underlying that labor market, maybe it doesn't show up in the unemployment rate. That is the big problem for the Federal Reserve heading into the next 12 months.
What do they do if that environment did materialize? What's the approach to that?
Well, they'll have to make some big decisions. So we heard from Fed Chair Powell, hey, we did work heading back in 2018 as to the type of inflation we should look through, giving himself some optionality. But this is a Fed that's going to have to ask itself questions over what type of inflation it does respond to. Supply side shocks, geopolitical fragility, these are not interest rate sensitive. So a Federal Reserve that talks a lot more about the type of inflation they would look through is one that might be erring on the growth side. For now, they don't have to make that choice because it's really the inflation side of the picture. As we just heard, the growth side looks on the surface at least to be well. I wouldn't be surprised if the Fed is also paying attention to the unevenness that exists under this economy. We talk about K-shape with incomes, high income folks really doing a lot better than low income folks, shows up in that retail sales data, but there's also that K-shape happening with manufacturing data and services data. This is not a simple economy. It's probably not a simple policy response. This, I think, is underscoring some of that confusion we're hearing from the Fed chair.
It raises this question of what kind of goals they have. I don't have a clear sense of what the goals are in terms of how quickly to get inflation down to 2%, in terms of how to weigh both the inflation reading and the unemployment reading, and what would trigger them to make a change. Did you have a clearer sense of that?
Well, from their SEP or those dots, they say it's okay if we wait several years to get back to neutral, okay if we wait several years to get back to 2%, and that seems to be okay by them. One of the challenges, I think, is this unevenness that exists under the surface. That unemployment rate is going to stay mechanically lower even as the labor market softens. This is a demographic story. And if we see deportations en masse, that could also contribute to the unemployment rate looking a lot better than the health of the underlying labor market. So this is a Fed that's going to have to look beyond its simple mandate, price stability and low and stable employment, and start asking questions about whether they're targeting the right numbers, or at least expanding the numbers that they're looking at in a more formal setting.
Does it make you more nervous to own risk, to buy risk, to take risk at a time of this much uncertainty and a real confusion, or at least disagreement among Fed members?
It will make anybody nervous to take risk. It will be more difficult for businesses to action on plans that they're going to take, or even for households to know what will interest rate policy look like moving forward. We're talking a lot about the market reaction and the idea that the market has moved to 2 or 1 cut for next year. That's fine. But how many business owners in the United States and globally incorporated a 10-year above 4%? And we're incorporating the idea that actually rate hikes could become part of the conversation. I don't believe that this is part of America's planning. And more importantly, I don't think it's part of the globe's plan. Because let's not forget, this week we have China yields collapsing. We had 3 out of 7 G7 countries have governments that went through sizable periods of problems. And we have, as you noted, John, really serious geopolitical fragility. This is not a global economy that can withstand 4 to 5% rates the same way the U.S. economy can. And while the Fed will say, we're focused on our own domestic economy, unfortunately, the rest of the world is going to be receivers of that Fed policy as well, and they are not in the same position as the American exceptionalism.
Saw that in emerging markets yesterday, that's for sure, in foreign exchange in the EM. I'd love your thoughts on this whole debate around neutral. Ahead of this decision, Governor Waller came out and said we were some way off neutral, we could keep on cutting interest rates. I'm paraphrasing, but that was the essence of the message from the governor. Where do you think we are relative to neutral, and where are they? Because I was pretty confused by some of the commentary in the news conference.
Well, there's certainly this new concept of short-term neutral versus long-term neutral. So where we should be in the short term is different than where we should be in the long term. I think that's really being fueled by the surprisingly massive amount of fiscal spending. We, I think, in the general consensus, are downplaying just how impactful the most amount of spending per GDP that we have seen outside of a recession in American history. I mean, this is massive, and it's distorting data. And when we talk about American exceptionalism, yes, we have productivity and AI, but guess what? A lot of other countries could be growing at 3% if they were spending as much as the US was spending on the government side as well. So that's really distorting short-term neutral, but there's a lot of concepts being thrown around, and my sense is, as I listen to this is a lot of trying to find reasons why they can stay on hold. This is a Fed that wants to stay on hold until they get some sort of crack in the data in one direction or another. This is probably where they're going to stay.
Francis, it's good to see you.
Nice.
Always fantastic.
Nice
Thank you. Francis Donald there of RBC. 2 dates for the diary. January 10th, payrolls. January 15th, CPI. And Mike McKee, I wonder if this debate will change all over again when we get those data points.
Probably a little bit. But the data point that's going to matter is January 20th. And 21st, maybe, when we start to see the executive orders, because everybody is waiting to see what happens with Donald Trump's fiscal policies. If I said yesterday, if the Fed decision and statement were on a milk carton, it would have an expiration date of January 20th on it.
Things could change a lot. By the time we get inauguration and we get the changes to policies, we've all got similar questions. I want to know which policy officials did not include policy assumptions or uncertainty, however they want to describe it, for 2025, and what those median dots will look like when they all start to do the same thing.
Especially given the fact that one of the reasons why they cut by 50 basis points was because the SOM rule was triggered. There were rules that they were looking at to understand where we were. Some of these linchpins have not held up to be the same kind of predictive tools. What tools and measures are they looking at now? It's sort of like the legal constitutional tests that you use if you're on the Supreme Court.
Okay.
I'm going to stop.
You're getting all legal now.
Well, it feels very similar. It's economic Supreme Court.
Days.
I mean, basically, that's
law school.
Yeah, but let's move on.
That was another dream. All right. Michael Kushma from Morgan Stanley with us around the table. Michael, we'll move on quickly. Don't worry. It's a conversation for another day. Let's talk, sir, about what you think changed yesterday after that news conference with Chairman Powell.
What changed was that we've cut rates 100 basis points, year to date. Policy rates are down 100 basis points easier, but the U.S. economy is stronger than it was a year ago, you could argue, with no sign that it's slowing down in the material wall at the top headline level. Nominal GDP growth is strong. Real GDP growth is strong. We had to slow down the pace of rate cuts. It's just, they had to. The question was, how do you transition to that slowdown? Do you do it incrementally, little by little, meeting by meeting, or you go like big bang? We're just reducing the expectations of rate cuts going forward in one go. And clearly the lack of consensus at the FOMC suggested that it was time to make that change.
Because, Michael, you've not liked long-term bonds for a while. You've been concerned about whether we're actually factoring in the inflationary and term premium types of pressure. Do you like them even less now, or do you like them a little more?
It's good. I dislike them the same amount, because 10-year Treasuries got to 5% in 23. That was when inflation was higher, and there was worries about how strong the inflation, how long it would take inflation to come down. I think we're in a better position today, even though they're upgrading their inflation forecast for 25. We don't quite know why they're doing that. Is it because anticipating changes in the Trump administration policies, or are they really concerned that the economy is overheating in some sense? But I don't really think that's true, because then they have it going back down again in 26, 27, and it's taking a longer period to get there. I really think that the curve is just too flat, and that the economy is stronger than expected, and policy rates are not likely to go much below 4% anytime soon. So you need some kind of term premium to get people to buy long-term bonds.
When we look back on this press conference yesterday, will we say that it was a policy error to cut rates at all, given the fact that they're talking about increasing their inflation expectation. And basically, the data that we just got confirms the strength.
It may be. This gets back to, where is neutral? Where is the economy's trend growth rate? If productivity is accelerate and the potential capacity of the U.S. economy to grow faster than 2% is here, I would say maybe they should stop now. But 5.5%, again, all measures, seems a high number. We hadn't exceeded or gotten even a 5%, 5.5 since the 1990s, I think. We peaked 5.25%, 5.5% in 06, 07. It's hard to believe that the economy is that much different. They need even higher interest rates than that. So bringing them down to the 4s in some sense seems equivalent to where we were pre-global financial crisis, in some sense a broad equilibrium for the economy given what we know. But if the U.S. economy can grow faster in the future.
Frances Donald of RBC was with us moments ago, just before you came on, and she was reflecting on the rest of the world. I'd like to finish there with you. What's going to happen to the global economy? Chinese bond yields are nosediving. There is a real conversation about that economy falling into the same disinflationary, deflationary trap that Japan entered all those decades ago. Europe's really struggling, huge structural growth issues. EM is battling with limited fiscal space in a world of climbing yields, which just means higher yields begets higher yields, and they've got a weaker currency to go with it and a central bank stuck in no man's land. What does the rest of the world do against this kind of backdrop? And how much can you stretch that band before it just snaps?
Well, a couple of areas. One is exchange rate depreciation. So you can offset it with that and support growth. But that usually has negative long-term income implications that your standard of living could fall as you use currency depreciation to support your economy, assuming you can do that. The other is fiscal space. Germany has lots of fiscal space. Germans don't like to use their fiscal space. So if they could use that, and the Eurozone has probably fiscal space in aggregate, but they're unwilling to use it. So the question is, will you use the policy tools you do have available?
The bond market's telling China they have that space too.
Well, it's... And they do, exactly. So you need to spur fiscal. We see it in the U.S. economy post-pandemic. You spend money, economies do better. If the government spends money, pours money into the economy, things will get better. Now you have to manage that trajectory over time. And some countries have more flexibility than others. Yep. Brazil has troubles right now. France has some troubles. So not everyone has that flexibility, but the countries that do have that flexibility should use it.
Michael Kushma, Morgan Stanley, thank you. That's the conundrum that we've got for 2025. The economies that need the fiscal space and want to use it can't. The economies that should use the fiscal space and have the space aren't. That's a big problem.
And that has been the problem, a structural problem for some of the economies that are in the most trouble right now. And that's really going to be the tension setting up at a time where there aren't the governments in place to do anything because the governments are not functional.
Canada, Germany,
Correct.
France, trying to
Correct.
figure all that out for 2025. Up next on the programme, we'll set you up for the day ahead and we'll catch up with Adrienne Yih of Barclays, looking ahead to numbers from Nike. We'll do all of that in just a moment. Getting closer and closer to year-end. A few more items on the agenda. Your week ahead looks like this. Today, Nike earnings after the closing bell. Tomorrow, core PCE and UMich sentiment. Next week, if you're still around, Conference Board consumer confidence and durable goods. And on Wednesday, of course, markets are closed for Christmas Day. With Nike earnings coming after the close, let's catch up with Barclays' Adrienne Yih, who joins us now for more. Adrienne, welcome to the programme. What are you looking for a little bit later?
We are actually looking for a miss, but the title of our preview note was that this is the first earnings call where you're going to have the new CEO, Elliott Hill, who had started kind of mid-quarter, sort of October 14th was his first day on the job. But the fact of the matter is there is a lot of heavy lifting to do here. The DTC, the direct-to-consumer, the digital channel, is showing signs of tremendous promotionality, and we've heard that from their channel partners as well as our own checks.
How much, Adrienne, are you expecting to hear about a consumer that is able and willing to spend, particularly in the U.S., renewed focus on the U.S.?
So what's interesting here is generally holiday has been intensely promotional. 30% off, 40% off, even 50% off as we go into the holiday season. It started even earlier, right? I think I've been on before telling you that we've moved from Black November to Black October to even the tail end of September. So people knew that they had a shorter holiday, a very intense holiday with the consumer under duress, and they started to grab wallet dollars earlier. So the interesting thing is that I don't know if we'd call it healthy, but the fact is that we are 96% employed. And when you tease that consumer with a tremendous promotion, right, they've been annoyed that everything costs 25% more. And so now they think they're getting value when it's 30, 40, 50 off. So I think this is a very different reason for why Nike is under pressure. They are resetting the business. They're pulling, product out of wholesale, and they're liquidating it, frankly, in their DTC channel, that so-called franchise management.
Stock is up by 0.9%. Looking forward to the numbers later. Adrienne, appreciate you dropping by. Adrienne Yih there of Barclays, looking ahead to Nike, seeing some big hits and some big misses in that space over the past month.
Yeah, as there is this rearranging in terms of wallet share when it comes to, I think that's the jargon. Is it wallet share?
Something like that,
yeah. That basically running shoes have.
You sound like you know what you're talking about, Bravo.
I know almost as much as triple witching and wallet share. And let's get to
the weekend. Let's get to the year end. Let's do that right now. Coming up tomorrow, one more day to go for Bramo and myself. We'll catch up with Jim Caron and Morgan Stanley, San Francisco Fed President Mary Daly, Kathy Bosjancic of Nationwide, Subhadra Japa of SocGen. To all of you out there, thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.